Okay, hello and welcome. I'm James Orr. Tonight we're going to be doing the 2 best investing strategies for our market right now. Here's some upcoming classes while last people straggle in. Summer's kind of a weird time with people coming to class. So here's the upcoming classes though while people are coming in late. Next week we solved the mystery of what I was going to teach. So if you guys remember from a couple classes ago, there was a class on I think it was like portfolio analysis or something very strange like that, and I didn't know what that class was going to be about. The good news is probably my favorite inspector, home inspector, Wes, I can't even pronounce his last name, Knackstead. He is actually retiring from being a home inspector, and so Brian and I thought it would be a really good idea for us to grab Wes. Did you do microphone at one point? To grab Wes and get some like behind the scenes inside information about what really happens with a home inspector, like what he sees in inspections normally, what's normal, what is unusual. I've got a couple really important questions to ask him myself about some stuff, and then what he thinks is important for you to be concerned about in your rental property. So this is going to be like 2 hours of us grilling Wes. And there should be no holds barred because he can reveal all his trade secrets at this point because he's not doing the business anymore. He's formally retiring. So it's going to be an interesting class. Brian and I will tag team Wes in order to get that thing. It's Insider Secrets of Experienced Home Inspector for Investors. And then after that, July 4th, there's not going to be any class. So please do not show up here on July 4th. You will be alone. And then after that, asset protection. There's going to be 2 parts of asset protection. How many people have come to an asset protection class before? Okay, how many people have not come to an asset protection class? Okay, so if you know all the classes we do, we try to record them, provided technology cooperates, and 99% of those classes actually go up on the podcast, they go up on the website, and they're available to all of you, okay? So all of the classes are available. There are like 3 classes that I'm aware of that are not available to you on the podcast and that are not available to you on the website. Clients of mine, someone who's bought or sold a house, have access to these, but everyone else does not. One of those classes is asset protection. So if you haven't seen the asset protection class and you are not currently buying or selling a house with us, this is the class you absolutely need to attend. You will not have access to the recording, so you need to attend live. There's a couple reasons why we do the asset protection like this. One of the reasons why is Brian is not an attorney. Brian teaches these 2 classes. Brian is not an attorney, and he has what I consider to be valid concerns about giving legal advice and how you should structure this. And I will tell you, before you even come to class, you absolutely should go talk to an attorney and get your own kind of plan evaluated by an attorney and get advice from them. But this should give you a ton of information about what kind of questions you should be asking, what the general thought process and structure of a lot of people that are doing asset protection for real estate investors is like. And so Brian does not want to have this out there publicly for anyone to go visit and see. And so if you don't attend live, you will not be able to get access to the recording. So whatever you need to do in order to attend those live, I would strongly encourage you to do that. And for the people that have actually seen it, is it good? Is it worth coming to? Are you going to come, I guess this is the best way to ask it, are you coming another time when he teaches it live? Is there anyone who's like, I'm not coming, I've already seen it once? No, see, it's really good. It's like great stuff. And I will tell you, first of all, he updates it every time he teaches it. He goes and he adds some things, which is bad because it's already 3 hours long for each class. But he'll add things to it. He'll kind of like edit some things, and he'll make some improvements, and we'll kind of tweak some things. If you guys remember the last time he taught it, I think, he added a strategy at the end about this really crazy irrevocable trust dealio, which basically eliminates the need to do all the other stuff. And he had just learned about it very recently, and so I'm not sure if he's going to go to Freaky Town and explain that or not, but it's something you don't see elsewhere. It's not just normal LLCs, and so for that alone, I probably would go, because it's a really interesting discussion on that. So this is how it's broken down. Part 1 of 2 is where he gives you the big picture of where your risks are, you know, how you could be attacked from above, how you could be attacked from below, and then how to structure your different entities and the pros and cons of doing that. And he talks to you about like real world implementation of asset protection plans for real estate investors. So that's all class 1. If you don't come to class 1, you will be completely lost for class 2. So please, please, please come to class 1 because he doesn't have time to teach an additional 2-hour class when he's going to teach class 2 to give you the background you're going to need for class 2. Because class 2 is all the forms and paperwork. So he goes over what's in the LLC, what's in your operating agreement, how to do the trusts and all the other stuff like that. That's all this asset protection part 2 of 2, all the paperwork and stuff. So part 1 is like theory and how to plan it and implement the structure. Then part 2 is all like the paperwork and everything else. So definitely come to both those. He doesn't give you the paperwork, which is why you need to go talk to your attorney, but he shows you examples of stuff that we're using. And it's actually really, really good where he goes into detail on that. So those are the 2 ones for you to do. That's July 11th and July 18th. And then I do this like twice a year at this point. We will go over the mid-year market stats. So I usually do market stats class in January. How many people came to the market stats class in January? Only like 3, 4 people? Okay, 5 people. So basically, I go to Freaky Town with charts. If you're into charts, you should come. If you don't like charts, you probably should stay at home. I go into tons and tons of detail about the state of the market. Now, how many people have gone to the groups meeting on their kind of like market stats in January, February, whenever they do it? No one's been to that? So if you go to that one, if you have a real estate agent who's part of the group and they invite you to that particular one, they do a lot of demographic type stuff. They'll talk about populations coming into Colorado and unemployment rates and things of that nature. So it's really good economic type of data. But the stuff that I go into is stuff like how much did prices go up historically and last 6 months or last year, days on market, whether people are bidding above asking price or bidding below asking price and how much they're doing that. I go into like crazy stuff. I'll show you like all sorts of things that you didn't even know you wanted to know about market stuff. It's like really, really good starts class. In fact, I would say if I had to say which class gets the most attendance, we have seen standing room only most in the stats classes. So if you're used to coming and getting a seat and you think it's okay to kind of stroll in 5 minutes late, if you come to the stats class, you're probably standing because we have all the seats filled up and people will stand for 2 hours to watch the stats class with me doing it. And for those of you that are like, James, it's not fair, you make people stand for class. I stand for class every time I teach, except for tonight when I'm sitting down the stool. So I don't feel bad about people standing for 2 hours. It's normal. Okay, and then that's mid-year market stats. So any questions on the upcoming class schedule? Awesome, thank you very much. So introductions. So Royce is going to do microphone. Who are you? And then what has been the best investing strategy for you in this market? So I tried to do this class because it comes across really weird if I just yell at you for 2 hours. So I'm trying to do this class as more of a discussion type class, which is why I'm sitting to remind myself to slow down and actually discuss things with you rather than standing up and yelling at you for 2 hours. But if you could tell me what's working for you, because we're going to discuss 11 different strategies tonight, and there's a bunch of like sub-strategies for them. Like wholesaling has like 3 or 4 different sub-strategies as one example. And then we're going to go over like what I think the 2 best ones for our marketplace are tonight. And you guys can come up with your own 2 best ones, but I'll tell you why mine are what they are. So, Royce, who are you, and what's been the best investing strategy for you in this marketplace?
So I'm Royce Quintana. I'm a local long-term buy and hold investor. For me, I guess the best property I've had is just finding it off market initially. I did buy it traditionally with James, but it was a multifamily property that worked really well for me. But otherwise, future stuff is probably looking a lot like these options.
So your best strategy was Nomad then, because you moved into that one, right?
Yeah, that was definitely the best one.
Okay, and we're trying to get Royce to. How many people came to Mary's class where Mary did the interview? Was that amazing stuff or what? Okay, so we're trying to convince Royce to actually come in and do what Mary did and be willing to share his numbers. It's really hard to convince an investor to be willing to say, by the way, here are all the properties I own, and these are the addresses, and this is how much money I make, and this is how profitable I am. It's really uncomfortable for people, as you might imagine. So be really nice to Royce, because we're trying to get him to do that. We're trying to negotiate how much it's going to cost me. Yeah, he saw what I gave to Mary, so he's like, I don't know. I might want to get a little bit more than that. We'll have to see.
Calvin and Caitlin, we're just getting started with the Nomad program and targeting some properties up here. So we're kind of checking that out. We've been doing the deal analysis spreadsheet and looking at some numbers. So we don't have anything as far as best investing strategy in real estate, but it's kind of competing for our capital in stocks and options right now.
Sure.
So just running those numbers and seeing how those stack up. So right
Awesome.
now it's tough.
Are you seeing like over 100% return in your stocks and options stuff?
Not over 100%.
Yeah, that's what Nomad is doing. So, hi.
Hi. What are we supposed to be saying?
Who are you, and what has been the best investing strategy for you in this market?
My name's Andrea, and I was lucky enough to buy a house in 2010 in Las Vegas.
Okay. That's
And
good, right? Because the market was down at that point.
If you look at the thing on Zillow,
Yeah.
I bought it, like I couldn't go back in time and buy it better,
And try to time it better?
pretty much.
That's good. Yeah.
And so buying when it's down has been my best thing because that's all I got right now.
Okay.
I'm
awesome.
just a newbie.
Very cool. Thanks. Welcome.
My name's Eli, and
Yeah, I don't actually think it does anything.
It doesn't amplify your
doesn't
voice in here.
actually do
It records it for the recording for the podcast.
I
So
remembered
it's
it.
not amplifying. Anyone here, you got to speak up, but please do keep it on so that people don't say I can't hear the people coming and what they're saying.
Sounds good.
Yeah.
I invested in the home that I live in now, but I bought it off market from my landlord at the time.
Okay. Awesome.
My name's Bob Thalen, and our best investment was a property we bought in 2010.
Yeah. So nothing in the current market is what I'm hearing everyone say.
I'm Alan Chen, and I guess so. I'm a long-term buy and hold, and I guess just I consider Fort Collins to be a Class A location with Class A properties. So
Yeah.
just buy and hold with appreciation.
Yeah. Yeah. I call it a blue chip market, right? It's a market that held up extremely well during the downturn, but the dividends on it aren't the greatest. I mean, which cash flow. So you're really just hoping for appreciation over the long term, I think, in a lot of ways in the Fort Collins marketplace. And there's some things we can do, we'll talk about tonight, to improve that. But overall, that's a generalization. I think that is true.
Hi, I'm Matt Weaver. I'm a local lender, and I'm trying to learn some new strategies because I haven't done it yet. So,
Nice. Awesome. Thank you. Welcome.
Hi,
Hello.
Denise. I like buy and hold. I really like new construction. I had a lease option deal that just closed and that did very well. So,
So lease options been working for you in our marketplace?
yeah.
That's super interesting. Might see some of that more tonight.
Dan Smith. I'm a newbie, and I'm interested in learning all I can.
Okay, awesome. Thank you.
I'm Kevin. I have yet to start my investment process as well, but I've been looking at the Nomad model pretty seriously.
Very cool. Might hear a little bit more about that tonight, too.
Renee Dunnigan, newbie, and yeah, Nomad.
Awesome. Thank you.
Jesse Langston here, just learning. No investments yet.
Okay, very cool. Looks like you got a little bit of sun. 5 minutes of sun? Yeah, you look really. That's what the phone does to you?
Just walking outside.
Oh, okay.
When I start glowing, you turn the lights off, and then it's real summer.
Yeah. You also have like really fair skin, don't you? Yeah. My son got literally blisters on his cheeks from going skiing. That's how fair his skin is. He's going skiing one day, got the reflection off the snow and the sun. You know, we try to teach our kids to wear sunscreen, but 17-year-olds, they know everything. Yep.
I'm Nick. My wife and I moved into half of a duplex.
Awesome. Thank you. Oh, look at this. People skipping over other people.
Austin Michelle. Part of ours was earlier 2012 and then nomading it since.
Yeah. Awesome. Thank you.
I'm Lynn. Best investment so far has been a new build in Berthoud, actually in 2011. It's ending up right next to the new TCP golf course. that's coming in.
Nice.
So we'll see what happens.
Did you
there.
know about it ahead of time?
No,
Yeah,
not in
totally lucky.
2011. We
Does
didn't
it
know.
back to it now?
Pretty much.
Yeah, that's awesome.
It's really close.
Those
so.
are really lucky plays, aren't they?
It was our first one, and it worked out really well. So
Yeah.
we've had a few dogs since then for sure.
Yeah.
But just recently in this market, we became passive investors in a house that had a fire, totally gutted, but it's in Old Town Arvada. So we'll see what happens.
Okay, awesome. Thank
That'll
you.
be a flip.
Sean and Angela, kind of in this market, we haven't really bought anything recently. It's, but I'm looking out of state just because Colorado's so high right now. But mostly it's just been buy and hold type stuff.
When you say Colorado's high, is that like a drug reference or is that like something else?
No, but it is that too. No, just cost-wise.
Yeah.
As far
Prices
as,
are definitely up.
Right, prices are definitely up. They're lower in southern states, southeastern U.S.
Yeah. There is a really good class if you're seriously considering investing out of our local marketplace. Brian teaches a class called CapEx, the Silent Killer. And in that class, he talks about buying these kind of like low-priced rental properties in other markets, and he runs the math based on real numbers of holding those properties, and he shows you they're not always what they seem to be. So I'd totally watch that class if you haven't seen that before. It's really insightful about how CapEx has a huge impact on those returns. And that's a podcast? It's on the podcast. It's also on the website. Yep. So both of those. And if you can't find it, just email me and I'll send you a direct link to it. Yeah. Hi.
Hi, I'm Laura. It's my first time here.
Oh, nice.
And I'm from California. I have flipped probably about 15 properties there. But it was the typical move in, fix it up, move out, make a profit, which was really easy. I found a couple really, really good ones just looking through the papers and made a ton wholesaling, but I haven't done anything here. Just got my license or just passed my exam, I guess.
Yeah.
And I'm really interested in lease optioning.
Nice.
So.
Cool. We'll definitely discuss that tonight. So the prices here look cheap to you? No. They don't look cheap for you from California? Oh, okay, okay.
They did a few years ago.
Yeah, most of the time people coming from California, they're like 400,000. You guys are crazy. That's super cheap. I mean, we're used to seeing $1 million scrape homes. So.
Hi, I'm Rob Madsen. The only strategy I followed so far was just buying a single-family house and renting out a couple of the rooms to some other guys around my age. And so far that's been great, but I hope to nomad that about a year from now. To try to get number 2 going. So we'll see how it goes.
Awesome, thanks.
I'm Nick, long-term buy and hold investor. I guess I haven't done any investing yet, but when I do, it'll be new construction. So
you haven't done the investing yet?
Not this year. You said this
market.
market.
Did I say this year? Okay.
I don't know. Is this market considered this year? Or
yeah, I guess I said, best investing strategy for you in this market. Yeah, I mean, I guess it's been really hot for a couple of years. It's not like something new. It's not like last year was really cold and all of a sudden it's like, really hot market. It's basically a lot more of the same. So,
my name is Elijah. I haven't done any investing real recently or in this market here. The last time was in a drastically different market, which is why I continue coming here.
Totally. Awesome. Thanks. Do we get everybody? Hey.
What is this nomading that?
We're going to go over it tonight. We're going to go over all 11 strategies. The question was, what is nomading? And by the way, for tonight, it's going to be a lot of discussion. So Royce is going to be going crazy with the microphone to try to get a good recording for folks that are not here locally. But if you have just a really short answer, go ahead and say it, and I will go ahead and try to repeat it into the microphone to try to limit Royce having to run back and forth when people are saying different things. But if you've got a longer question, if you're like sort of asking something, please do wait for the microphone and try to speak into it, because there's going to be a time when you're not able to attend live, and you're going to really want to hear what other people are saying. So if you do that, that'd be awesome. Okay, so the podcast, if you are not familiar with the podcast, we launched this probably earlier this year. We had probably a few years worth of classes saved up. There's now 118 recorded classes available, and they're all accessible if you go to podcast.ncraig.com. That will take you straight to iTunes. And I know, how many people in here are on iTunes? How many people are on something else, like Android or something like that? And if I send you to the iTunes link, you don't know, that doesn't work for you, right? You got to go somewhere else to do it? Because we have the ability to do it on a whole bunch of different platforms, but this is the link that goes straight to iTunes. If you need one to something else, let me know. I think Holly was going to put up a webpage that has links to all the other ones on there, and I think Royce is about to make a comment.
Yeah, you can go on Spotify or Stitcher or any of those, and if you just look for Nomad Real Estate Investing Podcast, it'll pop up.
Yep. So if you go on that, you'll be able to find it there too. So, but there's like 118 classes, and the classes are all about 2 hours long, and there's a ton of information there. And we're trying to do new classes all the time, although sometimes we teach repeat classes. So the 2 best investing strategies for our market right now. So what strategies could you do? So what do you think are possible strategies you can do in our marketplace right now? What do you think? Wholesaling. What else? Nomad. What else? I'll tell you there are 11. Hard money. We call it private money lending. Sure. Buy and hold. Lease option. Fix and flip. Tax deeds, tax liens, sure. Anything else?
Subject to.
Subject to, creative financing stuff. Okay. So here's my list. And I made a little note down here. It's not really super relevant, but the double asterisks are outside my personal area of expertise. If it has a single asterisk, I have clients or investors that have done it, but I have not personally done a lot of those investing myself. And then the ones that don't have any asterisk are things that I've done. So I'll kind of talk to you tonight about a lot of different strategies and how they're working. But that's sort of if you kind of want to know where my expertise is. And I'll be first to tell you there's a couple on here that I have absolutely zero expertise with. And I sort of made up what I thought pros and cons were. But if someone else here has more experience than me, please do contribute. Because I don't know everything. I do know like a really narrow area of things really, really well. And I know quite a bit about a little bit larger area. But there's some things that are just outside my circle of competence. So buy and hold. And you could buy and hold land, mobile homes, attached properties like condos and townhomes, single family homes, detached properties, apartments, commercial buildings that are not commercial residential, like office buildings, retail space, restaurant space, things like that, and then industrial things like big garages and car washes and things of that nature, okay? So there's a whole bunch of things in there. Creative financing, subject to wraps, owner financing. So those are some other strategies that we can do. And I'm going to go into detail on all these. I'm just kind of giving you the list right now. Development. Anyone mention development? Okay, so there's development. I don't know anything about that. We'll cover that tonight. Fix and flip. Lease options. Now, there's a couple different variations of lease options. There's buying on lease option, where you acquire a property, you take control of a property by getting a lease with the option to buy it. We're not going to cover a lot of detail on that tonight, but we'll talk about it when we talk about the creative stuff. Selling on lease option, which we'll cover quite a bit on. And then both, where you actually acquire a property on a lease with an option to buy, and then you immediately offer a lease and an option to buy to your end buyer, your tenant buyer. And so we call those a sandwich lease option, where you're actually acquiring on a lease option and you're selling on a lease option. Those are sandwich lease options. And then it's also master leases, where you actually have the right to buy a property too. You're taking over big apartment buildings and you have a master lease, and then you have a whole bunch of subleases underneath that. So that's lease option. Lending, private money, hard money lender. Nomad. We'll talk about Nomad in a lot more detail. Optioning, this is different than lease option. An option is where you have the ability to buy a property, but you're not leasing at the same time. So we'll go into that detail a little bit. Partnerships and other forms of syndication and crowdfunding. I kind of group those all together. Short-term rentals, vacation rentals, things of that nature. And then tax liens, tax sales. And finally, wholesaling, virtual wholesaling, and wholetailing. We'll cover kind of some variations on that as well. Any ones that you guys think I missed? Nothing? All right, cool. So tonight we're talking about kind of different ways to do deals, and I wanted to make sure that I was clear that we're not talking about ways to acquire properties or sources of deals, because in my mind those are different, right? You can actually acquire buy and hold properties by a number of different strategies, but you could also acquire properties for wholesaling a number of different ways, so they're not necessarily the same. So for example, you can find properties in the MLS, multiple listing service. You go contact a real estate agent, they help you find a property that you're trying to buy, you buy it through the real estate agent, and you close on it. That's pretty straightforward. But you can also find properties by doing things like direct mail. Anyone here send out direct mail in order to find deals? Anyone else? Just one person? No one else is sending out direct mail to find deals? Okay, there's some strategies that we're talking about tonight where that's the primary way of finding deals, is sending out direct mail. Okay, so we'll talk about that. And when you're talking about direct mail, there's a whole bunch of different variations of that. For example, you could go and send direct mail to people that are in probate, somebody who has passed away, and their estate now owns the property. And so you're trying to acquire a property from someone who is, from the heirs of someone who is passed on. And so that's probate. You can do direct mail to them. Some people like to do direct mail to people that have a lot of equity. So if you're trying to buy properties creatively and get owner financing, where you want the seller to act like the bank and finance the property to you, you can actually get a list of owners that either own their property free and clear or have very low loan balances where you could still come up with a down payment, maybe creatively through your own money or maybe through a private lender, pay off the small amount that they owe, and then ask the seller to carry back the difference as a seller financing. Okay, so that's one of the strategies. So if you want to find those deals, you may want to do stuff where you're mailing to high equity. Just out of curiosity, what percentage of the marketplace do you think are owned free and clear that do not have a mortgage on them? 15%? Not many? 6%? According to the US Census data, where the government goes out on your behalf, thank you for spending that money to do this research so I can tell you the number. Basically, they say that about 1/3 of all properties in the United States are owned free and clear, that do not have a mortgage on them. Okay? So in case you're thinking, you know, there's really no one to mail to if you want to go after high equity people, there actually is a pretty big mailing list for that. The mailing list? You can go to mailing list brokers. The one that I'm aware of, it's called listsource.com, and you can go match up demographic data and also property data on it. And part of it is, you know, the last time that they had a mortgage on the property, so they can go, every time you put a mortgage on the property, it has to go on public record. And so now you can go look at the date that that was and then the amortization of the thing. So if you have a loan that's 30 years old and it's 25 years since it happened, you can expect them to have a low balance on it or no balance. And so you can look at things like that. And you can go estimate what the value is based on some of that stuff. Yeah, Royce.
Is CoreLogic, or do they provide any information?
I think they do have some access to the list, but the one that I'm aware of, there's another one too. If you guys email me, I can go try to dig where the source is. But the one that I'm familiar with that I've used before is ListSource, but it wasn't recent in order to get that additional data.
Do you know where, I think you can buy some lists from like title companies too.
You can get public record-based lists from your title company. So if you go down to your title company, First American, Heritage, Stewart, any of the major title companies, you can actually go down them and say to them, I'd like to buy a mailing list from you. Tell them sort of your criteria. May not be able to do demographic-based data, but if you say I want all the properties for sale within a mile of this address, or if I want all the properties in 80525 or whatever it is, or all the 3-bedroom homes within that, they can do a list and pull that for you. And I think they usually charge, I'm probably like dating myself with the pricing, but it's like a penny or two per name. Maybe it's like 5 cents a name now. And they'll give you a list. And so you just pay for it, they give it to you on CD, or they email it to you. Okay? So you can go ahead and do those lists. Also, how many people are real estate agents in the room? For those of you that are not aware, our MLS, IRIS, actually has the ability for you to go into public record data through RealList, if you're kind of familiar with that. And in RealList, you can actually export 5,000 records per month from public record data. So you can pull your own mailing list if you're a real estate agent. And if your clients need a mailing list of a small, you know, group of houses or something like that, and they need access to a small mailing list, you can pull that for them as well. Okay, so you guys do that for free. It's included in your price. Yes. One second. What the? Yeah, no worries. If it's a short thing, I'm happy to repeat it. But if it's longer, I just want to make sure we get it on mic.
Some county assessor websites will do the same thing, run mailing lists. I was on, I think it was Larimer County or Gunnison County.
Okay.
And that had that option.
I wasn't aware that Larimer did it, so maybe it was the other one, because I didn't think that they actually do the mailing list on Larimer?
Yeah.
Okay.
I think it was Larimer.
Okay, interesting. I did not know that, so that's good to know. So the other one, if you're going after high equity, if you want to do homes that you can get owner financing on or do some creative strategies like that, that's the high equity list. You can go do mailing to them. The low equity list are people that have very low equity. So they recently bought a property last couple of years, and they have a really high loan balance compared to the value of the property. And so you may want to go do marketing to low equity people if you're looking for opportunities to find people are more likely to be in foreclosure if you're doing a low equity list. You may also be more likely to get someone who's willing to allow you to make payments on their existing mortgage, aka subject to or wrap financing. If you're going after someone that owes, you know, $270,000 on a $290,000 property, this might be a better list to mail to if you're trying to find properties where you can buy creatively. Does that make sense? Okay. And so you can do low equity. Absentee owners. What are absentee owners? Yeah, it can be out of state, but it doesn't have to be out of state. So I own a property in Windsor. Am I out of state? But I would also be on this list, right? Because basically it's any property where the tax bill is being sent to an address other than the property address. If you live in a property, where do you have your tax bill sent? To your house. If you don't live in the property, where do you have the tax bill sent? To your house. To your house, not the one that's that property, right? Not the investment property. So absentee owners is a way for you to find investors. Where are my wholesalers in here? People that want to wholesale. Raise your hands really high. You're not wholesaling anymore? Okay, 2 people. I thought it was just you. So actually 2 people wholesaling. So if you want a list of your buyers list of people that are actively buying in this marketplace, where's one list you could go to in order to find the most recent investor buyers that are buying properties like what you might have? absentee owners. So you could say, show me a list of all of the investor buyers that have purchased a property in the last year in the Fort Collins area or the 80525 area or whatever it is that your criteria is, and you can get a really small mailing list to do this and just ask them if they want to be on your buyer's list. It's not, what's that? Absentee owners. Like ListSource, the same places we were discussing before. Places like that can do it. Or this is one that's really easy to get. If you have a real estate agent that can pull up public record data for you, they can pull that list for you. Or a title company can do that one because it's not using demographic data. Okay? And then farming neighborhoods, you can decide, I really, really want to buy investment property in Huntington Hills because that's like the most amazing rental property neighborhood in all of Fort Collins, which it is not, by the way. So if you decided you wanted to go do farming neighborhoods, you could say, give me a list of all the properties in Huntington Hills, and it can give you a list of all those properties. You could do a mailing to them and farm that neighborhood. Like a real estate agent would farm for listings, you farm for investment. Does that make sense? Okay. Any questions on this? Direct mail, kind of list type stuff. Okay. Door to door. So you could go and knock on doors. In Fort Collins, you want to get registered with the city because it is a licensed activity. You need to get your little placard, put up a bond or whatever you're doing and do that. But in cities like Loveland or Windsor, I'm pretty sure they don't have door-to-door regulations. And so you can go door-to-door, door knocking, and try to find deals that way. So that's a way of finding deals. SEO, search engine optimization. You can go and actually try to optimize your website so when someone types in, sell my property in Fort Collins, you have a chance of coming up because you're a real estate investor that does this. This is extremely competitive because what does every real estate agent want to come up for as well? So you're now competing against thousands of other real estate professionals to try to get that too. So SEO is really hard to do, but if you can do it, great. Pay-per-click, this is kind of the way to leapfrog over SEO, search engine optimization. This is when you're willing to pay sites like Google or Yahoo or Bing or whatever they're doing now in order to have you come up when somebody actually searches for sell my house in Fort Collins. You can actually pay $17 every time someone clicks on that link, and then you have a chance of getting their contact information if they decide to fill out the form on your website. That's what pay-per-click's all about. And I'm only half joking about the $17. These clicks can be really expensive, and it's not per lead, it's per someone clicking through to your website. It's not like you're paying a certain amount of money for someone to give you their contact information. Networking. So a lot of real estate investors start off by coming to groups like this in order to find potential sellers of properties and try to find creative deals that way, and so on. So we have a whole bunch of classes on how to find motivated sellers. They're on the podcast and on the website. So if you're interested in any of these, I can't teach a whole class on how to find deals when we're talking about just all the different strategies tonight. But we do have like, I don't know, 10 different classes on how to do motivated seller stuff and how to do marketing. We have a whole 2-hour class on direct mail by itself. So there's a bunch of stuff in there. Any questions on, this is not a class about this slide. The 10 minutes I spent on it. Okay? All right, so our current market. So these are generalizations. If you come to the market stats class, I'll go into more detail than you ever want to know. But what's going on in our marketplace? What's happening? What's that? It's hot. Temperature-wise, and there's a lot of demand for properties. What else?
Well, I moved here 5 years ago. I could rent my second bedroom for $800 a month.
Okay, you used to be able to rent your bedroom for $800 a month a couple years ago.
Yeah, this past year, couldn't even get $500 a month.
So you think rents have actually dropped in Fort Collins on a per bedroom basis?
Last year, yes.
Okay, I'm going to show you some charts on that tonight. What else? Low inventory. What else is going on?
Lots of new construction.
Lots of new construction, although I didn't mention that. That's a good point, though. There is a lot of new construction going on. More so than we saw during the downturn. Anything else? A lot of appreciation. Yep, prices are going up, absolutely. Interest rates are rising. So prices are up. Rents are up, but not as much as price. I'm going to show you a chart showing you that. Okay? Days on market are down. So when a property comes on the market, they tend to sell faster than they have historically, although it's a little tiny bit softened than it was like 6 months ago or a year ago. But when you look at the big picture, like multiple years worth of data, it's still really, really low. So it's not at the very bottom, but it's still pretty hot. Interest rates are up, although Matt was trying to tell me very recently that they've kind of held steady since they've kind of bounced up a little bit. They've been kind of normalized at where they are right now. Months of inventory down. Months of inventory takes into account both the supply side, how many properties are available, and the demand side, how many properties are selling, and it merges that into one metric. And so this tells you how long it would take to go through the current inventory of properties we have on the market. That's what months of inventory does. And so months of inventory is down. So the number of months it would take to sell through the properties we currently have on the market is low. Okay, it's lower than it's been. Low inventory, high demand, and then that's pretty much what our current market is. Any questions on the state of our current market? Because it impacts what types of deals we can do, what type of strategies work in our marketplace. Any questions on that? Yeah.
So James, just to clarify.
You get our microphone. Good.
Just to clarify, when you're talking about our current market,
Yep.
could you define that? Are you talking specifically Fort Collins,
Yeah.
general area, northern Colorado, or what?
Northern Colorado. That's really what I was thinking of when I was saying that. Yeah, so like Fort Collins, Loveland, Windsor, Greeley, that sort of area. And if I didn't name like a Berthoud or a Evans or something like that, I meant to include those kind of like peripheral, smaller cities. But the big four, Fort Collins, Loveland, Windsor, Greeley, it's like those plus all the peripheral type ones. Yeah. All right, so these are two interesting charts. I'm very reluctant to say that they are from Zillow. Huge sigh. However, they're two from Zillow. Okay. So multifamily rents are climbing more slowly than single family rents. So there's two different charts going on here, and I wish I could kind of separate them out, but this is what's going on. So this goes all the way back to, I think, 2011 or so, and it shows both single family homes, that's the big green line, and this is, I think, the median or average rent, or the rent index, which I think is some type of like variation of the average or median. And then the blue one is actually multifamily units. So single family homes started off at around a little less than $1,250 back in 2011. They actually jumped up quite a bit. We saw pretty significant growth, but then they've sort of slowed down a little bit. And now in 2018, they're $1,420. So it's gone up quite a bit percentage-wise, but not quite, it's kind of slowed down a little bit here. And then multifamily ones, they kind of dipped a little bit in 2011, 2012. Then they kind of rose up very quickly, kind of almost in step with the single family homes, but then they've also slowed down quite a bit at the top, more so than the single family home ones. That's what I'm seeing in this chart. Okay? So if you're looking at this, both of them we saw this big uptick, and then they've kind of like stabilized a little bit where they're not quite going up as fast as home prices, because home prices have continued to go up. But rents have not. Rents have kind of softened a little bit, and they've kind of plateaued. And that's what we're sort of seeing in our marketplace, both for single-family homes and for multifamily. And this just shows you kind of like the first derivative for my math geeks out there, or the rate of change of the actual rent index. Okay, so it shows you that during this 2015 or so, we saw pretty significant increases. This is an annualized number from what I understand for both single-family and multifamily. But then they've actually started slowing down where they're not going up quite as much anymore. They're approaching zero, which is no change. Any questions on that? Okay.
Yeah, I assume the multifamily, that's like cumulative across all units.
It's got to be, but I don't know how they do their calculation because I didn't make this chart. Yeah. Okay, and then here's another one. This is showing just Fort Collins, and this is now showing the median rent in Fort Collins is $1,725 and grew by 0.9% over the past year. So back in 2011, the median rent was $1,300. It peaked all the way up to whatever this is up here, $1,750 or so, and then kind of traced back down over the last, I don't know what that is, a little more than a year, to $1,725. So for those of you that have felt in the last year or so that rents, especially in Fort Collins, have kind of dipped a little bit, we are seeing that. That is true. And so prices continue to go up, rents not as fast. And so we're seeing a small slowing of rents in our marketplace, which is another reason why cash flow is not as good in our marketplace. What really impacts cash flow? What do you think? Rent, what else? Taxes. Taxes are going up because property prices are going up. What else? Interest rates. So interest rates have gone up, and they've gone up pretty significantly, such that the cash flow on properties is actually going down partially because of interest rates. What's the last factor? Yeah, that property values. So property values are going up. Rents are going up, but not quite as fast. Interest rates are going up. Taxes are going up because of your price of your house. So all these things are kind of negatively affecting your cash flow on a property. Okay? So what does best mean? I kind of threw out this arbitrary title to a class, and I said, these are the two best strategies. Well, best in what way? So how can something be best? What are some things that you might measure to say, well, I'm really interested in this, so this could be a way that it's best? What are some different ideas? How could we kind of qualify what a best in strategy is? Profitable in what way?
Well, buy and hold and have appreciation,
Yep.
then is that appreciation going up?
So if you say appreciation, we're talking about long-term cap gains.
Right.
Okay? Which isn't spendable.
Yeah, but that's still value going up.
Agreed. So it is a value going up. Absolutely. What's another way you can measure it besides like appreciation for long-term cap gains, which isn't spendable? Cash flow. Sure. Now, when you're talking about cash flow, is it a cash flow based on percentage return? So if I'm getting 100% return on my money in cash flow because I put very little down, is that better even if it's only $5 positive? Or is it sheer dollar amount in cash flow? You know, does it have to be $200 a month? But even though that's only like a 2% return on your money, does it make a difference? What's important to you? Yeah, it's what's important to you too, right? So here are a couple different ideas. The best income from what I call real estate entrepreneurship. I make a distinction in my mind when I talk about real estate investing versus real estate entrepreneurship. Where are my wholesalers again? Wholesalers are primarily real estate entrepreneurs, meaning they're willing to get up in the morning, not usually investing a lot of their own money, but investing a lot of their time and resources into going and finding deals and converting those deals into some type of profit or cash. But they're not necessarily saying, here's $60,000 for a down payment, I want to get a return on my money. They're really looking for income from what is really a job. That's largely what real estate entrepreneurship is. Okay? So the best income from real estate entrepreneurship might be from wholesaling, might be from wholetailing. Basically finding a wholesale property and selling it to a retail buyer. Because traditionally wholesaling is what? Who doesn't know what wholesaling is? Okay, so wholesaling is when you go find a deal, and it's usually an investor grade deal, a deal that is so good that an investor wants to buy it. So they go out there and they will hit the streets, do some marketing, find a deal that's so amazing that another investor says to them, I would love to buy that deal from you and I will pay you a fee in order to take over that deal. And so Eli might go out and he might say, I found this deal, it's a $300,000 property, I'm able to buy it for $200,000. And he has it under contract, and he's talking to, is it Dan? He's going and talking to Dan, and Dan's like, wow, that is a great deal. If I could find a deal like that, I would love that deal. And Eli says, how much would you love that deal? And Dan says, I would love that deal a lot. How much money do you think it would take? And Dan says, I will pay you $5,000 if you actually give me that deal. And Eli says, sweet, $5,000 now. I will take my contract. I will assign it to you. You will then close on the deal with the seller themselves. You now have that deal where you paid Eli $5,000 to do that. And if you could do it once by accident, Eli says, hey, this worked out great the first time. Why don't I make a little business of this? I'll go find these deals and I will bring them to other investors and investors will pay me money. Okay? That's what wholesaling is. Now, wholetailing is, Eli realizes our market is crazy hot. He's not going to find a lot of deals that he's able to buy a $300,000 property for $200,000. So he gets smart. He says, there's a lot of buyers in our market that would be happy with a $5,000 discount on a property because they can't even buy the ones in the MLS without getting in the bidding wars and having to waive appraisal and waive inspection. And so Eli says, hey, this is what I'm going to do. I don't have to find these amazing investor grade deals. I could go find a deal, and even if I'm getting it at a small discount, or even if it's not a discount at all, but it's just a great property, I might be able to get a retail buyer to pay me a $2,000, $5,000 fee or whatever it is in order to sell this retail price deal to them where he could still make money. And so that's called wholetailing or wholesale retail, where you're finding a deal. It doesn't have to be a big discount deal, and you're retailing it to an investor, not an investor, a regular retail buyer. Sometimes we see this with great rental properties because a lot of buy and hold rental property buyers, landlords, don't need to get big discounts. They just want the property that makes sense, right? So you can go in there and Eli could go find a great wholesale deal. Maybe it's a fourplex where you can find it in our marketplace, and it's not at a big discount, but it's just the numbers are good. Does that make sense? Okay, so that's what wholesale is. And then options. Maybe you go out there and you actually get an option to buy a property, the right to buy it, but not the obligation, and you get paid a fee in order to market that property and sell it to another end buyer. Okay? So you can use options with wholesaling, or you can use them independently. So that might be one of your criteria for best, especially if you're a real estate entrepreneur. What about capital gains? If you buy a property, do some value add to it, fix it up or something, and you actually sell it for a profit, you made capital gains. And in most cases, unless you're holding it for over a year, it's short-term capital gains, like income tax rates. So you're able to get income from this, capital gains by doing fix and flips. Long-term buy and hold, then ultimately sell. You may decide, I'm going to go buy a property. Maybe I'm buying it at a discount, doing fix-up, renting it out for a year or 2 or 3, getting some additional appreciation, and then selling it 3 or 4 or 5 years down the road. Now I'm getting long-term capital gains tax rates, but I'm actually doing this for capital gains reasons. It wasn't necessarily a property I might otherwise buy for cash flow. And then best cash flow. That may be a best category. And is it largest dollar amount, where I can get the biggest dollar I can from a property? Or is it the best cash-on-cash return on investment? If you're able to go buy a property for 5% down or 3% down or whatever it is, and you're able to acquire that property, maybe even get the $50 a month positive cash flow on that property, is an amazing return on investment because you have a very small amount in. And I'll show you that tonight. And then short-term rentals, rooming house. If you go and you do, how many people came to Mary's class again? Do you remember Mary talking about getting roommates? Wasn't that pretty amazing? Her ability to go get like people in her house that are living with her, paying her mortgage, her return is insane. Insane numbers. Or there's some people that want to go and they want to get vacation rentals, where they're going to go buy a property and they're going to rent it out by the night or by the week or whatever it is, and you can get slightly higher, sometimes significantly higher, improved cash flow on those properties when you're doing that. And we're going to talk about the pros and cons of that when we get to that slide. But that's another way to improve cash flow. Then rooming house is when you rent your house by the room. You could have a 8-bedroom house in Greeley by UNC and decide to rent out the rooms for $500 or $600 per bedroom. And you can make some significant money doing it that way. Any other questions? Best overall return. So the 4 areas of return we're going to cover tonight. Appreciation. Appreciation is the tendency for property values to go up over time. They can go down short term, but over time, we tend to see appreciation be approximately what inflation is over a very long period of time. That's from Case-Shiller. And then cash flow on a property, that's after all your expense on the property, how much cash do you have that you can spend on the property or spend from the property. Depreciation are the tax benefits you get by owning rental properties, not vacant land. And then you get debt pay down. If you finance a property and your tenant is paying off the loan as part of their rent, you are getting a return from the debt pay down portion, basically all the principal you're paying each month on that payment. Okay? So what's best in our marketplace? In my opinion, this is sort of the criteria I'm sort of using tonight to determine what I think is the best investing strategy in our marketplace tonight. And so really it's ample supply. It is accessible to most people in Incraig. Is it possible that we could find one amazing wholesale deal where you made $300,000 on it in this market? And for me to go and list that as the best strategy would not be fair, because the majority of you could not go find that particular deal. So I want to make sure that we're doing deals where you are likely to be able to do it. The chances are great that you in this room could go do that deal. So that's what I mean by accessible to most people in Incraig. It does not require extraordinary capitalization. You don't need $1 million to do these type of strategies. If it's going to be a development deal where you need to have $1 million cash liquid, that's a problem for a lot of people in here. Okay? So capitalization does not require capitalization, does not require extraordinary income. You don't need to be earning $500,000 a year in order to do these deals. Doesn't require an extraordinary amount of time. So it doesn't require you to be a wholesaler, where wholesaling is a full-time job for most people if you're doing it right. And I probably should mention this too. So whenever I talk to wholesalers, they'll go to a course online, or they'll watch a video or late night TV or something like that, or they'll talk to a friend about wholesaling. And then they'll come in here and I will, sometimes unfortunately, I will make people cry, because I will tell them wholesaling in this market is really, really hard. And then people don't realize that at one point in time, I ran the largest wholesaling company in the United States. We were wholesaling in 280 markets simultaneously. We were marketing 280 properties at a time. That was my goal, is to always have 280 properties that we were wholesaling at any given time. So for someone who watched a late night video and then comes here and they don't listen to sort of like some of the advice I'm giving them, it sometimes boggles my mind. But so that's sort of where I'm coming from with wholesaling stuff. I have a ton of experience with wholesaling. So time. Wholesaling, to do it right, is a full-time endeavor. It is a job. It's a low-paying job too. I'll show you the slide later. You'd be better off getting a real estate license than doing wholesaling in the overwhelming majority of cases. Does not require extraordinary sales or other skills. So how many people in here, by raise of hand, could actually go out to a motivated seller right now and negotiate buying the property subject to the existing financing? Raise your hand really high if you can do that. Buying the property subject to the existing financing. Do you know what that is? Do you know the paperwork you need to do it? Do you know how to convince the seller of the benefits of doing that? Do you know what the downside and risks of the seller are? Okay, so when I say extraordinary sales or other skills, this is a sales skill. You need to be able to sell the seller on the benefits of doing a very creative real estate transaction. Okay, so in order to be best in our marketplace, I'm not going to require that you have these extraordinary superpower sales skills or stuff like that, because it's just not realistic. It's hard to acquire. It's hard to get good at that. It costs a lot of money in practice, because generating motivated seller leads costs money. If you're going to do them at any type of like size or scale, it costs a lot of money to go do that. So for you to go and spend $5,000 in order to get 10 shots or 20 shots at being able to do this and not knowing how successful you're going to be, when successful might be 1 out of 10 for someone who's good, and for you to have to learn by going through 20 to realize, okay, I guess I'm not good, and now you spend $5,000 to do that, you would have been better off taking the $5,000 and buying like a nomad property. Okay? So we're not talking about things that require extraordinary skills of capitalization, income, time, or sales skills, and it works with our current market conditions, which remember are hot seller's market with low cash flow, and the few motivated sellers. Are there a lot of motivated sellers in our market right now? Sellers who are having a problem or have a reason or are having trouble selling their property. Is that what we're seeing in our marketplace? Why not? Yeah, it's hot. They could go take their property, list it at the MLS, and get 5 offers the next day. So do they need you to... You put a sign in your front yard. So do they need you as a creative real estate investor who's going to structure these creative deals to come in and say, I'll buy your property at a 30% discount, or I'll take over your debt, or do something like that? In most cases, are they needing to do that? No, because they could get their cash the next day by going to list in the MLS or putting a sign in their yard. Okay? There will come a time when the market softens, and those will be needed skills. It's hard in this market. And there are some still, even in the really hot market, there are people whose situation dictates that they need some type of creative solution. But they're rare. They're not like all over the place. It's not like it's 2008 again. Okay? 2008 is coming again. It's going to be softened at some point. Be ready, but right now it's not. Okay, so now I'm going to start going through some of the different investing strategies. So we're going to talk about buy and hold. The types of real estate for buy and hold, and I'll just kind of dump out to you some of the pros and cons of the different types of buy and hold stuff that we've got here. And I realize that some of you are like, I don't need buy and hold. Get to the wholesaling one, right? Or you'll be like, hey, get to the development one, which I don't know anything about. But I'm just going to kind of go through them all so that you get a really good overview of all the different investing strategies. And then at the end, we're going to talk about which ones I think are the best, which you probably already know. Okay? So vacant land. Is vacant land a good buy and hold investment? Going out, putting $100,000 into buying a vacant piece of land and hoping that the property value goes up over time. What do you think? Sure. Yeah, you could speculate and actually put vacant land, and if the market property values go up a lot, you can do really, really well. What don't you usually get with vacant land? Cash flow. In a lot of cases, you got either money sunk into the deal with no financing, or you're feeding a loan while you're holding that property waiting for appreciation. So it's got to exceed your cost for the loan.
And the taxes are super high.
Taxes are, well, I don't know if they're super high. Yeah. Well, it depends on the type of land you're doing. Right? Right? If you're talking about regular, yes, or land in a neighborhood or whatever it is. So depending on what kind of land it is, your taxes could be really high or really low if it's like agricultural land, which is tiny. It's really, really cheap. We've got some agricultural land, which I think it's like $15 a year or something ridiculous for like 30 acres. So it's like super, super low for agricultural versus. But for other stuff, are you getting cash flow? No. What about depreciation? What's the rule for depreciation again? Right, it's only on the house. Remember, when we calculate depreciation, we subtract out the value of the land because we can't depreciate land. So you don't even get a depreciation benefit. So no cash flow, no depreciation. If you're not getting a loan, there's no debt pay down. So the only thing you really have going for you with vacant land for buy and hold is appreciation. Mobile homes. I have very little experience with this. I do have some friends that own mobile home parks and have done some mobile home flipping and type of stuff like that, but I have not personally invested in mobile homes. So what I'm about to say, take it with a grain of salt. What's the big benefit of mobile homes typically? Why would you invest in mobile homes to begin with?
Low price.
Low price, but what's the big one? Why do people like mobile homes? Cash flow. You tend to get really good cash flow with mobile home investing. Okay? So appreciation. Are mobile homes going up in value? No, so you're really not doing it for kind of appreciation play, but cash flow you're doing it for. What about the depreciation? You might get some depreciation. I have no idea how mobile homes are treated for depreciation. I don't invest in them. But I suspect you're able to depreciate them. It's a structure. What about, what's the last one? Debt pay down. So if you're actually financing mobile homes, which is harder to do, but if you are doing nicer ones, you're able to finance them, you will get some debt pay down. The overwhelming majority of the investors I know of that are investing in mobile homes are not financing them. They're paying all cash for them. So you're not getting debt pay down. So really one of the main reasons to do mobile homes, if you can find them in our marketplace, which is hard to do, is for cash flow. Does that make sense? Okay. Attached homes, condos and townhomes. Yep.
When you say mobile homes, is that the mobile home park or is that the actual mobile home?
So I've had clients do both. I had a friend of mine, actually 2 friends of mine, buy mobile home parks. And I've had another friend of mine who was buying basically individual mobile homes and doing a lease option exit with them. So he was paying $20,000 or $5,000 or whatever it is, and then he would go get a $3,000 option fee from somebody and rent to own the mobile home to them and getting good cash flow doing that. Okay. Attached homes, condos, and townhomes. So you kind of know what you're talking about. Basically just talking about those properties and getting the normal 4 areas of returns with those. In our marketplace, it's hard to get positive cash flow, but if you can, which there are some out there that you can get slightly positive cash flow, you can do that. Detached single-family homes, same thing, single-family houses, not attached to anything. Multifamily 2 to 4 units. So the interesting thing about these is the financing on them is really, really easy to get. Multifamily 2 to 4 is kind of the next tier for financing. Sort of easy to get, but not really, really easy and not really hard. And then after that, apartments 5 or more, financing is very different. You can get, for attached homes, detached single families, and multifamily 2 to 4, you can get 30-year fixed rate financing, fully amortized. What happens when you go to apartments 5 or more? Commercial loans. What's bad about commercial loans? They tend to be shorter amortization, not 30 years. They tend to be more like 20-ish, 25, 15, depending on where you're going to get them. What else is bad about them? Remember my saying about clowns? Balloons are for clowns. So a balloon is when you have a loan, the lender says, okay, I'll let you make payments on this loan as if you have 30 years to pay it off. However, you don't have 30 years. After 10 years, you need to actually pay me the whole balance that is remaining on the loan, or you need to refinance it either with us or with someone else. And by the way, we may or may not be doing loans at that point, and so you may not be able to refinance with us. So you could actually go in, get a loan on a 5-unit or a 35-unit or whatever it is, and 10 years from now, not be able to get new financing on that property. And they're asking you for the whole balance of the loan that's due. So if you had borrowed $2 million in order to do, a big apartment building, 10 years from now, they may say, we want $1.6 million on that property. You need to pay up the whole thing right now. Kind of scary. Okay? So that's the downside of some of the apartment stuff. Commercial buildings, like retail centers, things like that. Again, not an area of expertise for me, but my understanding is they can be really decent cash flow, but they can be very erratic returns. So you could have a great tenant in there like Blockbuster Video. And Blockbuster Video could be a great tenant for 5 years, and then what happened to Blockbuster? Have you seen some of the Blockbuster Video like retail spaces in our city? How long were they vacant for? Forever. Yeah. So basically, you could have had great cash flow for 3 or 4 or 5 years, and then are you prepared to have zero cash flow for a year, 2 years, 3 years on a property like that? Okay? So that's some of the risks of commercial. What about industrial? Again, not something I have a lot of expertise in. But someone who wants to have like a welding station or a little auto detailing place or something else like that. Same thing as commercial in a lot of ways. I think you get a good tenant in there, it could be great, and then it could be vacant for a little while when you have a glut of commercial space on the market, a glut of industrial, space on the market. Okay. So the 4 components of return. So these are the 4 different returns we've sort of been hinting at all night. Appreciation. What's appreciation again? The tendency for properties to go up in value over time. Can they go down in value?
Yes.
Yes. What about cash flow? What's cash flow? Money in your pocket after all expenses. So it's, yeah, it could be negative. Cash flow can be positive or negative. What about tax benefits? What are those? What do we talk about primarily when we talk about tax benefits?
Depreciation.
Depreciation. What about debt pay down? It's the part of the monthly payment that goes toward paying your principal, how much you owe on the loan. So if you're making a monthly payment of $1,000 and $200 of it is going to pay down what you owe on it, you're getting a return on that $200. That part of the $200 part of the payment, which by the way changes each month, that actually is a return you're getting. So if your tenant's paying that, you're getting that return. Then all four of these combined make up your overall return on investment, ROI. Okay? All right, so let's take a look at what the return on investment might look like if you bought a property all cash. So property values are going up over a very long period of time, about 3%. Fort Collins has been about 4%. If you look back to like the 1980s or so, last few years it seems really, really low when I say 3%, but look back 100 plus years, Case-Shiller says 3% is the number. So appreciation over a very long period of time is 3%. Cash flow, if you went and bought a property in our marketplace, I think I used a $200,000 property that had some positive cash flow. Basically, you're getting about a 1.2% return on your money if you bought it all cash. For those of you that are, how many people are cap rate guys? You like to do cap rate calculations. So just one person. So cap rate is your return if you actually bought the property all cash and you disregard a loan. That's the return you're getting. It basically is your cash on cash, not getting a loan. Okay? How many people actually do cash on cash as their calculation? What? Okay, all of you guys should be raising your hands because cash on cash is the primary metric we like to use here. It takes into account the cash flow you'd get and the financing you can get in your property. Okay, unless you're actually buying a property all cash, you should use cap rate for that. Otherwise, if you're getting loans, in my opinion, you should use cash on cash return. And that's primarily what we teach when we teach deal analysis in the classes. Okay, how many people use gross rent multiplier? Or how many people use things like, they say things like the 1% rule or the 2% rule or something like that? How many people use those? No one? Use the 1% rule? So the 1% rule is really a bastardization of the gross rent multiplier. Okay? So most of the time we're using cash on cash. All right, so cash flow, 1.2% is what we're estimating on this particular property. Debt pay down, we're assuming we're buying it for all cash. No loan, no return from debt pay down. And then your tax benefits, if you take a property, you subtract out the value of the land, you divide that value of the actual building by 27.5 years for a residential property, you end up with about 3% of the value in tax benefits. That's what that works out to be. So if you add up 3 plus 1.2 plus 3, if my math is correct, your overall return on investment buying just the hypothetical property here in northern Colorado is about 7.2% ROI. If you happen to get an amazing property that has like a 7 cap or an 8 cap or something like that, we've seen a couple of those from time to time, then this goes to 8. And so it becomes like 8, 3, and 3, which is like 14. So 14, I think, is on the high end of what we're likely to see in our marketplace. Does that make sense, everybody? Okay. So I assumed a $200,000 property with $200,000 down. Your full net operating income is your cash flow. 3% appreciation rate means a 3% return. And then no return from debt pay down because you don't have a loan. What happens when we leverage it with 20% down payment? Increases our returns by about a factor of 5. So let's run through those numbers. Same $200,000 property, except now we're going to put $40,000 down. We're going to get a loan for $160,000, 20% down. Okay? So now we've got about $200 a month positive cash flow after the loan. Take into account all of your expenses on the property. And by the way, this is an exceptional property in our marketplace. It's hard to find $200 a month positive cash flow in our market. First of all, it's hard to find a $200,000 property in our market, period. But then in addition to that, it's basically a $200 a month positive cash flow after all expenses. Most of the properties you're analyzing in our marketplace right now are about break-even cash flow when you do like a full calculation with vacancy, maintenance in the property, and everything else. Okay? So now we're saying we're getting $200 a month positive cash flow, so I'm being super generous with this. So these are the returns we're going to get to. 3% appreciation rate, so the same appreciation rate we just talked about before. If you do that, you have a 3% appreciation. Why is there a 15% return from appreciation then?
Because you keep it all, not the bank.
You keep it all, not the bank. That's not the answer I was looking for. Yes, so both of you guys have the right answer. So it's because you're only putting down $40,000, you're getting the full appreciation on like 1/5 of the investment. So a $200,000 property that goes up 3% in a year is how much? What's 3% of 200,000? Where are my real estate agents in the room? All real estate agents can multiply by 3%. What is 3% of $200,000? What is it? $6,000. Okay. So $6,000. If you actually had $6,000 on a $200,000 property, it's 3%. If you have a $6,000 return on a $40,000 investment, what's that? Hint. 15%. Okay? So you got a 15% return because you earned $6,000 here, but you only invested 40. Make sense? Okay. So now, cash flow, you basically made $2,400 in positive cash flow on a $40,000 investment. Trust me, if you do the math, it's 6%. At least I hope it is. Okay? So that's where you get 6% for that is. Debt pay down, there's a whole class we did on debt pay down and what the return is. What is it? Trust me now, believe me later, believe me now, trust me later. Whatever the saying is that I'm supposed to be saying here, insert that there. But basically, if you have a 30-year loan and you put 20% down, the return you're getting on the debt pay down of that loan is 5.51% per year. So you're getting a 5.51% return by paying down the loan on that one. So that's the return you're getting on the $40,000 investment. And then your tax benefits, you take the value of the property itself, subtracting out the value of the land, you divide by 27.5 years, you get a dollar amount, divide that dollar amount by $40,000, you get 14.55. So the overall return you're getting when you do financing is 15 plus 6 plus 5.5 plus 14.55. Add all those up together, I believe it should be 41%. So when you look at a property from the 4 different areas of return for buy and hold, with decent cash flow, 6%, you're getting 41% return. Pretend for a minute you're in a crazy market. And in the crazy market, you don't get cash flow from investing in the property. You buy a property, you get 0 cash flow. Is that hard to imagine for you guys? Okay, it's like reality, right? So imagine for a second, in that crazy market, properties are only going up 3% a year. You're getting a 15% return. You're getting a 0% return from cash flow. You're getting 5.51 from paying down your loan. And you're getting about 14.55 from the debt pay down. 14.55 and 5.5 is about 20, plus 15 is 35. So you're getting about a 35% return on your money, even in a market where you have no cash flow. Does that make sense? That's why buy and hold is interesting. Okay? Now, is this spendable money? Could you feed your family with this? No. Can you feed your family with this? No. Can you feed your family with this? Yeah, I think you can. You multiply this number by whatever your tax rate is, and that's how much cash flow you get from depreciation. So if you're in the 20% tax bracket or whatever it is for your effective tax rate, you multiply this by 20%, and that's what your actual cash flow is. The spendable cash flow, the money you get back on your taxes or the money you don't have to spend on your taxes when you own rental property. Does that make sense? Okay. So this is what I'm trying to say by this is you're getting about a 5 times return. This class is going to be 3 hours long, by the way. You're getting about a 5 times return than you are when you buy a property all cash doing this. I'm going to speed up. So vacant land, we talked about this already. You're getting only the 3%, no cash flow, no tax benefits. Why aren't you getting tax benefits again? Because it's no depreciation, because there's no structure. No structure, it's vacant land. So 0% there, and if you're actually doing all cash to purchase it, you get no debt pay down. So this one, it's about 3% overall. There you go. And I basically said you're feeding the property, you're paying property taxes, insurance. Some people pay insurance on vacant land because they're concerned someone's going to get injured or something stupid's going to happen there. A lot of people don't, but some do. And then a mortgage if you financed it. Okay. You often need to put higher amounts down. So I've had some clients buy vacant land before, and some of them actually financed it. And if I recall correctly, from memory, most of them had to put half down. So if you're buying a $100,000 property, you have to put down 50% in order to finance vacant land. Okay. So buy and hold. Pros and cons. You get 4 areas of return, and it's often 30% plus with leverage. So if you're putting 20% down, the return, the overall return that we just went through in excruciating detail, when you calculate all things, even with no cash flow, exceeds 30%. Does everyone believe me now? Okay. Often 5 to 10% return without leverage. If you're buying the whole property all cash, and you're getting your cap rate, and you're getting appreciation, and you're getting no debt pay down, but you're getting tax benefits, it's probably pushing 5 to 10, especially if you can get a really good cap rate property. It can be a little bit higher than that. Relatively low time investment to maintain. Is doing buy and hold hard? Does it take do you have to have a full time? You have to commit full time to doing it? What do you think? No, it's relatively good time commitment, right? Relatively low initial investment. Do you need $1 million to go do buy and hold? No. How much do you need? 20%? Someone said 3%. It's hard to do investment property at 3%. Nomad, sure. But if you're doing straight up buy and hold, non-owner occupant loans, what are we looking at? 20% usually. They are as low as 15%, but you do pay PMI. So you could do as low as 15% for those in order to do them. Nice long-term, often fixed-rate, balloon-free financing. So you can get a 30-year loan, hold it for 30 years, not have an interest rate risk. You don't have to worry about interest rates going up while you're holding the property, and there's no going to be balloon due where someone's going to say to you, you need to pay me $200,000 because that's what you owe. Okay, so that's really, really a big pro of this. Any other advantages, pros you can think of for buy and hold? All right, cool. So some of the downsides. There are occasional capital expenses. Occasionally someone smokes meth in your property. Occasionally a roof goes out and it's not hail. Occasionally you need to buy a new furnace or new hot water heater. So you do have capital expenses. You need to save for those and budget. It's illiquid. It's harder to buy and sell than securities. It's not like you can just call up your stockbroker and say, sell half my property. I need some cash this week. Okay? Can't do that. Cash flow isn't amazing in our marketplace. So if you're looking to do buy and hold because you're wanting to generate cash flow, it's hard. It's really tricky in this market. Okay? So it's really hard to do. High demand and low inventory in our marketplace. So a lot of people want duplexes, triplexes, fourplexes. A lot of people want the good single-family homes that make good cash flow. So it's high demand, low inventory, harder to get these deals in our marketplace right now. It's limited to 10 loans on your Social Security number before you need to seek portfolio financing. And by the way, portfolio financing is not this long-term, fixed-rate, balloon-free financing. A lot of the portfolio financing is 7-year adjustable mortgage, where it's fixed for the first 7 years and then it goes variable after that. A lot of them are 30-year loans, so you don't have to worry about a balloon calling it due, but it becomes variable after like 5 or 7 years, depending on which one you get. So once you get past 10 loans on your Social Security number, it's tricky. Now, if Royce and I were married, he could do 10 in his Social Security, and I could do 10 on mine. Okay? So you could split it with you and your significant other. Yeah. Well, so the question was, what if you have a corporation? Can you do more loans like that? And so the answer to that one is most of the time, the only lenders I'm aware of that will loan to an LLC are only doing portfolio financing. So they're only doing 5-year ARMs or 7-year ARMs or stuff like that. So if you're doing partnerships, you're probably doing a portfolio lender. It's hard to do the 30-year fixed rates ones with LLCs. Yeah. All right. Creative financing. So I'm going to go, there's like, I don't know, half a dozen 2-hour classes on creative financing on the website. So I'm going to go pretty quick. But if you're interested in creative financing, partially because I will tell you it is not one of the top 2 for our marketplace, I'm going to go fast here. But if you really want to do it and be prepared for when the market does change and it's going to be good for you, go listen to those like 12 hours worth of additional training. Okay? So owner financing. Owner financing is when the seller acts like the bank and they accept monthly payments or yearly payments or whatever payments you guys can structure together in exchange for you buying the property. So they are acting sort of like the financing bank and accepting financing for it. So you don't have to come up with all the money. Rent to own, lease option, lease purchase. You're going to go to a seller and you're going to say to them, I really want to own your property. I can't get a loan right now, or I'm not willing to get a loan right now. How about I lease the property from you? I pay you a monthly or yearly fee or whatever we work out. And then a year or 2 or 3 down the road, I have the ability to buy that property from you, ideally at a fixed price, where I can do that. That's sort of what this rent to own, lease option, lease purchase are. There's some nuance difference between the description, but they're all essentially the same thing. Okay? Wrap financing. Wrap financing is how we technically do subject to correctly in our marketplace because it gives the seller recourse in case you stop paying them on the loan. So when I cover subject to, I will go back and cover wrap financing, but let me continue for now. Agreement for deed, bond for deed, contract for deed, installment land contract. This is, I'm going to go to Robert and I'm going to say to Robert, I'm going to make you $1,000 a month payments. If I do that for the next 12 years, you are then going to deed the property over to me. We have an agreement where if I make monthly payments to you consistently over a period of time, at the end of that, you are actually going to give me the deed or title to the property. It's sort of like when you go and you get a car note, where you don't actually have title to your car until the car is paid off and you've agreed, you paid as agreed. It's that sort of for houses. So you have either agreement for the deed, a bond for the deed, a contract for the deed, or you're making installment payments for a contract on property, real property. Okay? Loan assumption. So FHA loans are assumable. They're qualifying assumable. Back in the old days, we used to be able to non-qualify assume loans on properties. So there were loans out there where you could go in and you could say to the seller, I will take ownership of your property. Here's $5,000. I will start making payments on your loan. I will assume it from you. And I didn't have to go qualify with the lender who loaned him that money to make sure I was qualified to do it. We just started making payments. And that was a formal loan assumption. That doesn't work anymore. There's actually, I can't think of an example where there's a non-qualifying assumable loan out there. There are qualifying assumable loans where if you have an FHA loan and you go and you qualify for it, you could take over their loan. Why is that important? Yeah, so we may, 5 years from now, when the rates go up to 7, 8, 9, 10%, we may be able to go find an FHA loan where it has a 3% interest rate or 3.125. And we may say, hey, your loan is valuable. So I will give you $20,000 for your equity, but I will actually want to assume your loan so I don't have to go get a 7% loan. I can get a 3% loan or a 3.25% loan. So later on, this may become really valuable. If you have any FHA loans, that's pretty interesting. Okay? Right now, though, not so interesting. Okay, last one, subject to. So I'll explain this subject to like this. So Royce, as a hypothetical, just went and bought a brand new $300,000 property. He's a veteran. He has that's probably a bad example, but he got a 0% loan. So he didn't put any money down to $300,000 property. And just after he closed, his company says, guess what, Royce? We don't need you anymore. You're fired. So Royce goes on a bender, decides to go off the deep end, gets married, goes to Las Vegas, gets married, decides he's not going to get married, gets divorced, comes back here, he's feeling really bad for himself and decides, I'm just going to leave Fort Collins. I'm going to go live back with my parents. And where are your parents from? Mexico? New Mexico? New Mexico. Pueblo, Colorado? Something like that. Anywhere. He goes basically, he's like, I'm leaving Fort Collins. I don't want my property anymore. That just was really bad. I know. Okay, so anyway, he decides, hey, I'm leaving town. I don't want this property anymore. I don't have any equity. If I were going to go try to sell it with a real estate agent, I just bought it last month. There's no equity. I had to bid it up above asking price. So I don't have anything in here. I just want to get out of this. So Royce is talking to me over a beer, and he says to me, I'm just going back to stay with my parents. I don't care about the property. I'm going to let it go into foreclosure. I don't want it anymore. It's basically upside down anyway, and I'm never going to buy a house again. You know, I'd be lucky if I'm alive in 6 months. Okay. Royce, let me do this. Let me do you a favor, buddy. Instead of you actually letting your property go into foreclosure, how about I actually take ownership of the property, and since you may never ever be back, you're going to need to give me ownership of it. You're going to need to deed me the property. But I will make your mortgage payment. I'll pay on it for you. So you're going to deed me the property, and I'm going to make the payments on your existing mortgage. I am not going to go to his lender and qualify. I'm not going to tell the lender that, hey, listen, I'm James. I've got great credit. I've got all sorts of money. I want to formally apply to take over his loan. I'm not going to refinance it. The loan is going to remain in Royce's name. The property is not. The property is now going to be mine because he deeds it to me. Now, his alternative is I'm going to get a foreclosure. So is me coming in and making payments on his existing loan better for Royce or worse for Royce? Better. So I'm going to go in there and I'm going to make payments on his loan, and everything's going to go great. 5 years from now, I'm going to have tenants in the property for 5 years, and then the property value is going to go up, and I'm going to actually sell it and make a profit. And at that point, I will make all the profit. The loan will be removed from Royce's name, and everything's good. That's subject to. You're buying the property subject to the existing financing. Okay? Now, the Colorado Consumer Protection Agency does not want you to do that because Royce goes away and 6 months later, something happens to me and I stop making payments on the loan. What is the recourse that Royce has with me? What can Royce do to kind of say, James, you're screwing me. You're not making payments on my loan as agreed. What can I do to you? Not much. So what the Colorado Consumer Protection Agency or whatever it is wants you to do is, first of all, get advice from an attorney, but then probably they're going to want you to do wrap financing. So basically, Royce says to me, I will give you a loan, and we're going to wrap my underlying loan. So it's basically going to be the exact same terms of the loan that he has. But what's interesting about it is I make the payments either directly to Royce or to his lender, but if for some reason I don't pay, Royce can say, I'm going to foreclose on you and get my property back so that I can make payments and protect my credit. And that's the protection part of it, and that's why they like that. Okay? So I told you I'd cover wrap financing when I covered subject to. I did that. So basically I explained to you what subject to is and why we don't do it, And then wrap financing, why we do that, if you go talk to an attorney and get advice on how to do that in our marketplace. So, remember before I asked you how many people feel qualified to go talk to a motivated seller and structure one of these subject to deals? Remember before I told you what's the criteria for best deal? It's something that people don't really have extraordinary skill and all that other stuff. That's why it's hard to do these. Because you need a lot of skill, and you need to be able to understand the correct paperwork and the correct structure and all the pros and cons for Royce as to why I can do it. And they're never as clean as that, right? They're never like Royce is like, I'm moving to, what do we say? Pueblo? Yeah, back to Pueblo or wherever he's going. So we're not doing that. It's hardly ever that clean and clear. A lot of times there's complications. He's behind on his payments 3 months and all sorts of other funkiness going on. So you need to know how to deal with all that stuff. There's training on it, but you just need to have a lot of time and do that. And then how do you find Royce? I ran into him at a bar in this case, but it's really, really hard to find him. Okay? Okay, so what are the pros? They can be little or nothing down. Did I give Royce money? Could I have given him $1,000 to go, here's travel money to go to your parents? Would that have been little down? Sure. And by little down, I mean less than 20%, right? So could Royce need $5K? Let's say he bought it 6 months ago and now he has $5,000 or $10,000 worth of equity. Is it reasonable for me to pay Royce $5,000 or $10,000 to be able to take over his loan? Yeah, and so it could be little down. There also could be expenses to finding the property. And by the way, you'll have more deals with money. If you tell me, I have $0, James, but I want to do this creative financing stuff, how many deals can you do if you have absolutely $0? Very small. I got to find a particular type of Royce that's willing to do it with like $0. Am I more likely to find versions of Royce who need $5,000 or $10,000? Yeah. Am I more likely to find ones that maybe need $20,000? Yeah. And so the more you have, the more options you'll have for your deals. And so if you're used to doing if you're doing marketing and you're able to do 1 out of 10 deals, if you're fully funded, maybe you're only able to do 1 out of 30 deals if you're not funded at all or very, very poorly funded. Okay? No number of loan limits. How many loans can I take over subject to that will impact my personal credit? It's not on your personal credit. I can buy in the name of an LLC. I guess that's not my next bullet point, but it's coming. So I don't have to actually be the personal one that takes over Royce's loan. I could actually have a new LLC, the 1234 Main Street LLC, buy Royce's property. I don't have to qualify. And that could be a 30-year fixed rate loan because that's what Royce got. Okay? So I don't need to qualify. It's not on my personal loan. There's no formal qualification. The LLC is not going to his lender and saying, qualify me. Could have been formed yesterday. You can buy directly in the entity itself. We just talked about that. And then much more time invested to find them. I don't know why that's a pro. That's probably a con, right? Because it's not like you can just go out to the MLS and say, oh, James, show me all the subject to deals available. I'd like to go look at those. That's not how that works. You need to go and invest time in marketing. You do stuff on postcards, set up your postcard system, take phone calls from sellers, a lot of tire kickers. You need to go out there and meet with sellers. You got to make a lot of presentations. You got to hear a lot of no's. So there's a lot more time and energy invested and money in doing that. Another con, you need to hire an attorney. By the way, for all this stuff, you should hire an attorney. Even for buying a house regularly, you probably should hire an attorney. Get good legal advice. But in this one in particular, do not do these without an attorney, guys. You absolutely 100% should bring in an attorney, especially for your first couple deals. Often need to spend money on marketing to find motivated sellers. There's an upfront investment in time and marketing. It may cost you, I have some clients that are doing marketing. It wouldn't surprise me, I don't know their exact numbers, but it would not surprise me if they're spending $5,000 to $10,000 to get a deal in marketing. Okay? Worth it? Probably. In some cases, loans can be called due. So when I actually go and Royce deeds me the property to my LLC and the loan remains in his name, the lender can, at their option, call the loan due because there's been a transfer of title and now Royce is no longer the owner of the property, and so the lender can, at their option, say, wait a minute, we didn't loan the money to 1234 Main Street LLC, we loaned the money to Royce. Royce is now no longer the owner of the property, so we would like to be paid the full amount of the loan that is due. And the lender has that right to do that. So there is a risk when you buy these properties that the loans can be called due. And for those of you that are searching late night on the internet about ways to circumvent the due on sale clause, I'm going to use this trust thing and all this other stuff, I will tell you the trust thing, go look up the Garn-St. Germain Act. And if you look up the Garn-St. Germain Act, you will see that you are allowed to move your property, personal property, into a personal trust for estate planning purposes, but as soon as you are no longer the beneficial interest of the trust itself, you do still trigger the due on sale clause. And talk to your attorney about this in detail, but that does not solve it. Moving it to a trust does not circumvent or get around this loan being called due. It may make it harder for them to see, but that does not mean that it can't be done. Okay. They are really hard to find in our current marketplace. Why? Because in most cases, Royce can just go put a sign in the yard and sell it. Right? So they're hard to find in our marketplace. And it requires a high level of specialized skill. So we have a ton of resources here on all the different ways to do creative financing. Just go to the podcast or my website. You can get access to all those things. All the classes, by the way, are like up here. All right, so development. Again, my assessment of this particular strategy may be very, very inaccurate. This is really going to go 3 hours. I'm going to start really flying. So my assumptions, rumored to be at the peak of the risk pyramid. So if you go talk to anybody about doing development, it's at the tip of the risk pyramid. It is the most risky thing you can do. Okay? Requires partners and/or significant knowledge and/or significant financial resources to do this. So most of the people are not going to be able to do this or not going to want to do it. We've had some clients look at doing some development. Ultimately, they decided not to do it after evaluating it all, which I think is the case for a lot of folks. And then Tammy and I actually looked at doing some preliminary research on doing some development in Fort Collins. We ultimately decided not to do it after evaluating it and talking to some of our kind of like colleagues in the commercial space. And it is really risky. Really big rewards, but really big risk. Okay. So development. Larger numbers, bigger dollar amounts. Harder to find more traditional deals. Might be better to develop to get your own discount. So if it's hard to find deals at a discount, you might be tempted to say, I'm just going to go build a duplex, or I'm going to go build a triplex, or I'm going to go build single family homes so that I can get them at a small discount and make my numbers work better. That's the pro, right? That's what you're thinking. Cons is longer time to complete project than most of the other options. There are labor challenges. How many people have tried to hire a handyman or contractor recently? Yeah, hard to do, right? Imagine doing that at scale where you're trying to hire people to do all this other stuff. Yeah. Shorter term financing. These are not long-term financing situations on this. It requires larger capital than most investors have, and the profits likely taxed at ordinary income tax rates. Shortage of infill opportunities in our market. So if you think, I'm just going to do 1 or 2 single family homes, it's hard to find lots to build single family homes, like 1 or 2 at a time. Really, really tricky. All right, so fix and flip. The idea behind fix and flip is you find an undervalued property, you buy them, you add value. Oftentimes it's by doing repairs or upgrades. Sometimes it's just fixing a timing issue or some type of weird liquidity issue. But overall, most of the time it's going to be repairs and upgrades. And then you resell for capital gains. So some of the pros. It is possible to generate short-term profits from doing that. So those people are like, I want to generate money to be able to go do buy and hold, which, by the way, you shouldn't do. But I want to go do that. I want to go do fix and flip so I can get $20,000, $30,000. And I'm going to use that to then go buy my next property. Or I'm going to go use that to live on as kind of like income. That's what this is a pro of. That's why it's good to do. Easier to sell properties in a strong seller's market. So right now, if you can find fix and flip deals, super easy to sell. Because the market's super hot and you've got a perfectly conditioned property that you've rehabbed, it's really, really easy to sell it and get top dollar. Market may go up while you're doing your work, so that's a pro. So you bought it, 6 months later, that's how long it took you to do your rehab, which probably shouldn't take that long, but it takes you 6 months to do it. What happened to the market in that last 6 months? It went up. So all of a sudden you thought you were going to make $20,000 profit. Now what are you making? More, a lot more in some cases. Okay? Whoops. Cons, this is a job. If you think you're going to be able to do this part-time, that's a huge mistake. Really, really hard to do part-time. You got to be on top of your stuff. You got to be all over it. It's harder to find deals with enough spread. There's not a lot out there. And the spreads are being tightened because people with crews, professionals that have been doing this for a while, they've got their whole team in place. They're hungry for deals. They're like, normally I wouldn't do a deal with only $15,000 spread, but I can't find anything to keep my guys busy. 15,000 is better than nothing. I'll do that deal. And their margins are like great because they've really got it dialed in. The temptation in the hot market to do deals with smaller profit margins. And so here's the downside of doing that. Everything is great until the market turns. You think, okay, I'll do this one for 15 and maybe the market will go up over the next 6 months and instead of making 15, I'll make 25 or 30 or whatever it is. And then all of a sudden what happens? The market stalls. And now you're caught with a relatively tight margin property and you're chasing the market down. You don't adjust your price quickly enough because you think, hey, I don't know why it's not selling. Just showings are slow this month. I don't know why, but it'll pick up. And then next thing you know, the month after that, you're like, okay, I guess I should drop the price $5K, and the market's already moved down 10 or 20K from there. So be careful about that. The false belief that the market will continue to go up indefinitely. You heard it here first. At some point, the market will turn. Property values will go down. Okay? It's inevitable. They do not go up consistently every single month, month over month, forever. So at some point, the market's going to have a correction. You know, our model is pretty much buy through the corrections, just kind of dollar cost average or dollar value average, but it's really hard to time the market and do this. It's harder to find fairly priced, reliable contractors. That's another downside of doing this particular strategy. And then you're taxed at ordinary income tax rates. All right, lease options. So, several flavors of these. We covered in creative financing the buying on lease options, sandwich lease options, and master leases. So we're not going to cover that again. We're primarily going to be discussing selling on a lease option. So you acquire property any number of ways, and now you're going to find a tenant buyer. A tenant buyer is a tenant who's going to be renting your property for a period of time, and then they're going to have the option to buy it from you. They're going to buy it from you later on. And they're going to live in the property for 6 months, a year, 2 years, whatever it is, until they buy it. And we're going to be talking about selling on lease options. That's what we're talking about here. You can combine this with other strategies. For example, you can acquire as a nomad and then do lease option as your exit. You can acquire as a straight buy and hold and do your lease option as exit. You can do wholesaling where you're finding your tenant buyers and putting them together and wholesaling that deal to someone else. So there's all sorts of variations on that. So pros and cons. So Matt, are you getting any calls from people yet where people are telling you, I don't quite qualify, or you get them on the phone and you're finding they don't quite qualify, they need 6 months or something like that in order to get a loan? Oh, yeah. Okay, so whenever I do this, I ask the lenders in the room, you know, how many calls you do that, and like without a doubt, they're all telling me, I get a few a week. Okay, when they're doing any type of volume, they're getting a few calls a week where people are telling them, I need 3 months or 6 months or a year or whatever. I need to have my bankruptcy fall off or my short sale to fall off, or I had this medical collections bill, but now we're back on track, or you know, I just started a new job and now I need, you know, pay stubs, or I started my own business and I need 2 years tax returns. There's all sorts of reasons where people can't qualify for a loan today, but in 6 months, a year, 2 years down the road, they're going to be qualified. There are lots of tenant buyers. Okay. Don't be fooled into thinking that this is a very small number of people. There are lots of them out there. We have a question. Royce is running over.
I'm one of them.
Yeah, there's a lot of them. There's lots and lots of people that they have some reason why they can't do it. You know, real estate agents who, you know, they haven't documented their income, or any number of reasons for doing it. So lots of them. Another pro of doing lease options. So when you do a lease option, let's say Royce now, he's not the seller anymore, he's not motivated. He basically comes to me and says, hey, listen, I want, or maybe he is motivated. Maybe he's now in Pueblo, and he comes to me and says, hey, listen, I had this property. I was about to be foreclosed on. I had a bunch of late payments. I can't qualify for a loan anymore, but I really do want to buy a property. And so he says to me, I would like to lease option a property from you. I'd like to lease a property from you with the option to buy it a year or two down the road. I say, great, Royce, no problem. How much do you have as an option fee to put down toward purchasing the property? And Royce says, well, when I sold my property up in Fort Collins, I got a $15,000 upfront, you know, a kind of a fee to kind of get my equity out of it. So Royce says, I've got $15,000. I say, great, that's exactly how much I need in order to do the option for you now. And Royce says, perfect. That makes sense to me. So now, instead of me coming in, and when I go buy a property for Royce, and I let him option the property, instead of me coming up and doing $60,000 down, I basically put $60,000 down to purchase the property, but I immediately get $15,000 back from Royce as the option fee. So how much do I have in the deal? 45. Now, when I have less in the deal, what happens to my returns? It goes up. It amplifies the returns. Okay? So you get amplified return, and it gives you an additional margin of safety. So if I had bought a property and I'd put $60,000 down, and the market dropped a little bit, I'm out money because I actually put up the full down payment. But now that I bought this property and I got $15,000 from Royce, if the market goes down the first $15,000, I don't have a loss. I have a margin of safety from his option fee. Does that make sense? I'm almost like buying it at a $15,000 discount in some ways. Does that make sense to everybody? Yeah. Okay.
Big difference is just to note that you're crediting that $15,000 back to the buyer at the time they decide to execute on the property and buy it.
Yeah, so we usually recommend that. It is negotiable. But we actually do recommend that you credit the $15,000 toward the purchase for that buyer. Okay, so you get amplified returns and you get additional margin of safety on your investment. You tend to get improved cash flow. So rent on the property Royce wants to lease option from me might be $1,800. But because I'm going to go buy the property, one that he picks from the MLS, and I have this additional risk of offering it to him to buy on an option, and he's got 2 or 3 years to do it, I say rent on Royce would normally be $1,800. However, because you have the ability to option the property and buy it, I'm going to charge you $1,850 or $1,900 or whatever I decide is fair and whatever he agrees to. So a lot of times it's a slight premium on what normal fair market rent would be. Or the other way to think about it is there's always a range of rent. Rent is not an exact number. And when you do rent to owns and lease options, it tends to be on the very high end of the range. That's another way to describe it. Okay? So improved cash flow. Allison, would you open the door for a second to get some air in here? Slightly above market rents, and then the upfront option fee. So if you didn't want to think about the $15,000 that Royce gave me as kind of part of to lower my down payment, you could also say, instead of getting that as a reduction in down payment, it's almost like upfront cash flow. So now if it's over 3 years, he has 3 years to buy the property, I basically got $5,000 per year in additional cash flow, about $400 more per month in cash flow from doing that. So I can either say I have less invested in the deal, or I got this huge amount of extra cash flow on the property. Okay? And then possible reduced maintenance. A lot of times, if Royce is going to be buying the property from me, I might say to him, so Royce, you are going to be living in this property, and since you're intending to buy it, you are responsible for maintenance. And so I expect you to cover the maintenance on the property that you are the owner of, or you're going to be the owner of. And so he actually is responsible for maintenance, which would reduce my maintenance on the property. Now, Royce gave me his last $15,000 in this hypothetical example. If the hot water goes out or the furnace goes out and Royce does not have enough money to do the repairs, who's buying a new furnace? I am, as the landlord. Now, when I sold Royce the property on the rent to own, I said to him, you're getting the property in its current as-is condition. You're getting a 15-year-old furnace. The furnace goes out. I need to come up with $3,000 to buy a new furnace. Are Royce and I going to have a negotiation about where that $3,000 for the new furnace is coming from? Because he's getting a brand new furnace, which was not part of our initial deal. So maybe I add it to the purchase price. Maybe I have him pay me $100 a month to finance the furnace over time, or maybe I structure something else. I probably would add it to the purchase price. Okay?
Do you pre-negotiate that?
Yes. A lot of times you do. Yep. And then reduce vacancy. If I'm going to buy another, buy and hold property, might I have a month to find a tenant, or might I have a vacancy after a year or 6 months or something like that? Yes. But if Royce is coming in, he picks the property, and he's saying I'm paying rent from day one because as soon as you close, I'm moving in. Now I have less vacancy on that property. So you have reduced vacancy when you do this. So what are the downsides? Need to talk to a lot of tenant buyers. That is one of the big downsides. Okay. Not every tenant buyer is going to go for this particular arrangement, so you have to talk to a lot of them. So there's a lot of time and effort into it. It's not hard, but it is definitely time intensive. Larger time investment, and may not be the property you'd otherwise choose for your portfolio. So I go to Royce and say, okay, you have $15,000 as an option fee. Go ahead and pick a property from the MLS. And he picks a property that I would not otherwise buy, but it works for him. I can say, no, that doesn't work for me. Go pick another one. But in a lot of cases, provided it's not like an extreme, unusual property, I might say to him, yeah, that's not what I would normally buy, but it's close. And I would be willing to do that for you. And so it might not be the ideal property you'd otherwise pick. And it gives away some of your potential upside, because a lot of times with Royce, I'm going to say to him, your purchase price in the first year is 3% more than what I bought it for, plus all the closing costs. And then the second year, it's 3% more than that. And the third year, it's 3% more than that. What happens if the property goes up 10% in year one? Who gets that? Royce does, not me. So you're giving away some of your upside on that. But what happens if the property value goes down? Yeah, so we have the option fee. But if it goes down enough and Royce doesn't want to buy it, who's stuck with the property? Me. That's my risk. Okay, so you're trading different types of risk and reward. Okay? So quickly running through these numbers. This is before when we did the regular 20% down payment, the same math I did before. I'm just showing you it again. Remember, the return in this case was 41%. If you do a lease option, I tried to kind of simulate it with the same property. $200,000 house, you put $40,000 down, but Royce in this case gave me $10K option fee. So now I only have $30,000 in the deal, which is 15% down. And now I get $250 a month positive cash flow. Before I was getting $200. Now I'm getting $50 more per month. So that's a little bit improved positive cash flow. And I should be able to get at least $50 a month premium. And then same 3% appreciation rate, because that's what Royce is buying it for. Whoops. So you do that. Now your appreciation rate return is not 15 anymore. It's 20 because it's the same appreciation, but I have less in the deal. Okay? So now it's 20% return. Cash flow went from 200, which I think was 6%, now goes up to $250 a month, which is $3,000 a year on a $30,000 investment, which is now 10% cash-on-cash return. Your debt pay down improved because now you only have 15% in the deal instead of 20%. So now your return on that is 6.5% per year. And then your tax benefits, because you have less in the deal, are 19.4. You add all these up, and the math should be 56% return. Before they were 41, now they're 56. So you get improved return by doing this. And it's less risky. Does this sound like it might be an interesting one for our market? Okay. So because this is a relatively popular play and a lot of investor clients do, and in general, the way we come up with classes is I find a hole in what someone's knowledge is, right? You come to me and you say, so James, how do you actually screen tenants? And I say, that's a great question. Come to class this Wednesday because we're going to teach that. Because rather than teach it one-on-one and me do a half-assed job of explaining to Royce how to qualify tenants, what I would rather do is spend a full day, compile all the best resources I know on how to screen tenants, and teach a 2-hour class where Royce can get it and 15 or 20 other people in the room can get it, and then it's recorded so that the next time Nick says to me, hey, how do I screen tenants? I could say, Nick, go watch this 2-hour video, and then let's go grab pizza or grab a burrito, and we could talk about whatever questions you have that are above and beyond that. Because this will give you the best stuff I got, but if you need clarification, I'm willing to have a much better, deeper, higher level conversation with you than just like, here are the basics again. So this is how we basically come up with special resources for stuff. Okay? So some special resources for people wanting to do lease options, there's a ton of classes on it. Go look at all the different classes. There's classes on how to analyze deals, classes on how to get out of the lease option, classes on how to screen tenants. I did a whole 2-hour class on the psychology of tenant buyers, which was crazy good because I had a whole bunch of clients at the same time buying lease option deals, and I'm like, I don't think we've ever taught a class on what's going on in the mind of someone who's calling in on your lease option deal. And so we go into Freaky Town about what they're thinking about, how they're thinking, what they're, kind of how to talk to and all that stuff. So there's a whole bunch of resources on that. One of the other things that we have was the challenge was people were having tenant buyers saying, okay, yeah, you go find a property in the MLS and I will go ahead and buy it for you. And then the tenant buyer would go look at a property in the MLS. They'd say, so what would the numbers look on this deal? And they'd call up the investor, and the investor would have to go in their calculator and calculate what the purchase price would be, what the rent would need to be in order for them to hit their numbers for their return, their desired return. So the solution I had is I created a tool for our clients that basically had a website where you on the back end as the investor put in, this is my desired return, these are the cities I'll do, this is the price ranges I would do, and then it actually does the calculation and shows them how much they would need to put down and what their rent would be in order to hit that return for the investor. So there's a tool I have for clients that they can use to do that. Okay? Here's another challenge that's come up. So calls from potential tenant buyers to explain the rent to own. So a while ago, I used to offer to clients, hey, listen, if you want me to, I will take calls from your potential tenant buyers. I will talk to them. I'll explain them in really general terms how rent-to-own works, what the pros and cons are of it. But then ultimately, it is up to you to negotiate the terms of your existing tenant buyer lease option scenario. Okay? And so it saved my clients from having to do 90% of the calls because all they had to talk to the people that were like, yeah, that sounds pretty interesting as you described it. Let me talk to your investor so I can get the exact details of their thing. So I used to do that. It's just not practical. Just really, really hard for me to do all that. So what I think the new solution is going to be, and it's almost what this class was tonight, was I'm going to make a new 1-hour video. And the 1-hour video is going to be really generic. It's not going to say anyone's name. It's not going to name any of the details of the program. But it's going to be the 1-hour class for tenant buyers on how rent-to-own works, how the numbers work, what the pros and cons are, kind of how it's structured, all that stuff. And then it's going to tell them, contact the person that gave you this video or the phone number that's located around the video. And then clients, or they could actually put this on their website and send people to it to have them watch the video, get the explanation, and then they could call you to get the next step. Okay? So I'm thinking about doing that. How many people think I should do that? Yeah, that's the problem. All right, so I guess I'm doing that at some point. So that's the idea. So basically it'll do that. So that's basically lease option. I will jump to the end of the presentation and tell you that's one of the top strategies in our marketplace right now. Okay. So lending. Private lender, hard money lender. What's the difference between private lender and hard money lender? What's that? Both hard money and private, they're both lending you the money. So what's the difference between the two? Yes, private is someone you know. You go to grandma and over Christmas dinner you say to her, I'm really getting into this real estate investing thing. I have all these properties I could buy. If only I had a little bit more money. And grandma says, I've got $1 million in a CD at 1%. How much do you need? And grandma decides, I'll loan you the money at 3% because it's 3 times what I'm earning in my CDs. And you say, thank you very much, grandma, I accept. Okay, that's private. Because grandma's not in the business of going out there and loaning her money to other people at 3%. A hard money lender is someone who's in the business of loaning you money, and their rates are probably going to be more in the 12% range, plus points. Grandma's not charging you points in most cases, unless your grandma's really astute, or you have a really big mouth. Okay. So individually or with a local fund. So there's some people that they're like, I don't want to be in the business of going and talking to one-on-one person and loaning them money on an individual deal. What I'd rather do is give my money to a company that is a hard money lender, have them pay me a 6, 7, 8, 9, 10% return, and then they're loaning it out at 11, 12, 13% return, and then they're charging points, and that's how they're making their money. Okay? So you can actually go and be a person out there doing it as a business, or you can give the money to like a local fund, someone ideally who is licensed and insured and has all their stuff in line, and then you're actually doing money that way. Crowdsource funding. How many people are aware you can go on the website now, look at all these deals, and actually give money to people that are looking to do deals, a lot of them in other markets? You guys aware of that? So you can actually become a lender by going and investing in crowdsourced deals. Sort of beyond the scope, but that's kind of one of the things you do there. Okay, so lending. I gotta fly. Pros. Has the appeal of more passive. So when you actually just have your money out there, it's a very passive type investment. Not a lot to do. Higher cash on cash returns than we're seeing in our marketplace. If you're getting 8, 9, 10, 12% on your money, a lot of times that's better than what you're getting cash on cash. But you don't have the other areas of return. Cons, hard to have all your money out invested at one time for the entire year. So here's the challenge. You're a hard money lender. You have $1 million in the bank and you think you're going to get 12% per year on that money. Here's the reality. You come to all the investor classes. Takes 6 months for someone to find their first deal that you are willing to fund. It's $250,000 they need. So you put out $250,000, you start getting 12% on that, and that's out for 6 months. You still have $750,000 that's not getting that return. Okay? Another 3 months goes by, you find another investor, you put out another $250,000 on it, now you have $500,000 out, but $500,000 just sitting there not really getting anything. And it's got to remain somewhat liquid, unless you're doing like a HELOC or something on your house, which adds additional layers of risk. Okay? So the reality of most hard money lenders is they're not going to have all of their money out at any given time, and there are going to be periods when they're getting very low rates of return and periods when they're going to get very high rates of return, and believe it or not, it tends to be feast or famine. You're going to get 6 people that all want to borrow your $1 million at one time, you're not going to be able to have enough to lend it out, and then there's going to be other times when you're sitting on $1 million, you have no one to lend it to. So your returns are much lower than 12% you think you're going to get, and that's the reality of doing hard money lending. What's that? Yeah, cash drag. Not a lot of opportunities to invest in our market. So there was another hard money lender that was in Denver that used to come up here and run like local meetups and do stuff like that. The rumor is, and I'm not 100% sure this is true, but I will spread the rumor because it seems true, is the rumor is they stopped coming up here and doing meetings because they ran meetings for over a year and had 0 people do deals up here. Okay, so there are not a lot of hard money opportunity lending deals up here. And if you look at some of the other hard money lenders that are local in our marketplace, they're not just focused here. They're doing stuff really wide, like all of Colorado and into other states, in order to get enough deal flow to make it worthwhile. So if you think you're just going to do it and do Fort Collins, Loveland, and Windsor, good luck. Hard to do. There's only one area of return. That's the cash on cash return part. No appreciation, no debt pay down, or no depreciation when you do it as a lender. All right, so Nomad. Really quick overview of Nomad because I think I beat this horse to death on all the other classes. So you buy a home as an owner-occupant. Guess there's an arrow thing going on after that. You live there for a year. You buy a new home and convert the previous one to a rental, and then you repeat the process until you have all the rentals you want. So you're buying a house, putting little or nothing down in some cases, 3% down, 5% down in most cases for buying the properties. You're living there for the year as a requirement of the lender. And then you're converting those to rental properties until you have 1, 2, 3, 4, 5, 10, 20, 30, whatever rentals numbers you want. Okay, that is the strategy for Nomad. Now, because we teach like 50 different classes on Nomad, that's all you're getting tonight. But trust me when I tell you, it is amazing. Okay? So there's a reason we teach 50 classes on this one topic. And I go to like freaky town on every little aspect of it. So go check out all the podcast stuff and everything else. I will give you another hint. There are 2 top things. What's the first one you think? Lease options. What do you think the second one is? Okay. All right, so pros and cons. You can invest with little or no upfront down payment. May need to add down payment over time. So a lot of times when we're putting up little amounts of money, do we have positive cash flow or negative cash flow? We're going to have negative cash flow a lot of times. So you're really having to do like a down payment over time in the form of negative cash flow. That's what we're seeing. You have improved cash flow over traditional non-owner occupant buy and hold. Why do we have better cash flow on a Nomad property than we do on traditional non-owner occupied buy and hold? Interest rate is better when you're doing owner occupant. Okay? That's why. You may have PMI, but that often goes away over time. In a market that's going up 10% a year, how many years does it take you to get 20% equity? 2, maybe 3, maybe 3.5, maybe 4. Doesn't matter. It's still not for the whole time unless you're getting FHA. Okay? Higher leverage means higher ROI. So if you're only putting 5% down and you're still getting $9,000 in appreciation for that year, no matter what you put down, you have $9,000 over a smaller number or $9,000 over a 20% larger number, which one's going to give you a higher ROI? The same dollar amount over the smaller number gives you the higher ROI, okay? So that means higher leverage means higher ROI. What are the downsides? You need to move into the property. I did a class where I talked about how to do Nomad without moving in, but really what were those strategies? Big down payments. Basically not having to move in to do non-owner occupied. And what was the other one? Anyone come to that class? Yeah. Creative financing, buying property subject to and stuff like that. Those are the 2 big ways. Typically we don't have positive cash flow immediately, so that's a downside. Unless you get roommates, everyone remember Mary, crushing it, getting roommates. And or you have an exceptional property, which sometimes you find just a property where it's just amazing. Like Royce's deal where he found a duplex. The numbers were just awesome. They were just great. Exceptional though. You can't expect that every time. Put more down. So if you want to get positive cash flow and you were going to put 5% down, maybe you do put 10% down if you have the extra cash to do it. Or buy down your interest rate if you want to improve your cash flow. We have a whole 2-hour class on doing that if you want to watch it. Okay, so those are downsides. So this is the same number before, 41%. You already covered this. If we do Nomad, we're going to put 5% down. Now your return from the same 3% appreciation is 60%. Because you have 1/4 as much as you had down before. So it goes from 15 to 60. Cash flow, we're assuming because you actually only put 5% down, you have no cash flow. 0. So this goes to 0 in that case. Your debt pay down is 10% now. That's the return you're getting on paying down a loan. And your tax benefits are 58%. 4 times is what it was before. The overall return when you do that is 128. Remember, who was doing the stocks? Was that you? Didn't I ask you, you're getting 100%? You should do at least your Nomad property. Do whatever else you want with the stocks in your spare time, but do 1 a year. This is better. So 200K house with 10K, 5% down, break even or slightly positive cash flow, not counting tax benefits, 3% appreciation rate. Leveraging the 5% down payment increases returns almost 20 times. Craziness. All right, option fee. So you get the right but not the obligation to buy a property. So remember we talked about lease options. You're leasing a property and you have the right to buy the property. The lease part of it is your ability to stay there. The option is your right to buy. There are times when you actually only want to get an option fee on a contract, okay? On a property, rather. What's tricky is, and I really don't have time to go into this, but it's important, especially my wholesalers. What is a listing agreement? When you're a real estate agent and you have the right to list a property for sale, what is that really?
Saying that they'll only sell through you.
They'll only sell through you, but really what does it like mechanically look like? Doesn't it look sort of like an option? Where you're saying to them, I'm going to sell this for you for $300. I'm going to have basically 6% less than that. I'll pay half of it to a buyer's agent and half of it goes to me. It's really like a very, when a really twisted way, and it's not legally an option, but it looks an awful lot like an option agreement when you think about it. Okay? So, similar in many ways to wholetailing, you can go and get an option to buy a property and not actually lease it, and then you could sell the right to buy the property to someone else. There are 2 books, if you're interested in this strategy, there are 2 books on how to sell properties using options. One of them I think is by Lucier or Lucifer or whatever his name is. It's like that. And then there's another one by Bill Efros, and it's misleading because the book is about how to sell your property in 5 days using an auction system. But if you got it under a contract as an option, you can use the 5-day sale program in order to sell the property and have an option on it. So if you're interested in that, email me. But there's some really interesting things you can do. So you find wholesale opportunity and then finding the retail buyer to do that. So options, often little money required to option the property. Usually need to do marketing to find motivated sellers, so you're not going to be able to go just find people off the street doing this. Generate short-term revenue income. You can do that with options. Usually requires money to do marketing for the sale. So this is not a zero down type of deal, but requires some money to do it. Usually requires significant time and skill to find, negotiate, and do these. This is not a beginner strategy, which is why probably most of you have never heard of it, right? How many people have heard of doing options? Yeah, it's unusual, okay? It's taxed as ordinary income. So partners and other forms of syndication crowdfunding, we typically talk about 3 roles when you come to the partnership class. I got 3 minutes. This is going to be awesome. Deal maker, money partner, and loan partner. We do we set up classes where we have people teach about partnerships. It's a 2-hour class. And then the next class, we have you come. We separate the room into 3 groups. And you say, you've got the deal, you've got the money, you've got the ability to get a loan. All of you work together, come together, negotiate terms of partnership. We'll group back together at the end, and we'll discuss what you all negotiated. Really good class to practice doing that. A partner can be more than one role. There are advanced variations, syndicating larger or serial deals. Syndication is when you're like the deal maker and you're going out there and forming the partnerships. Putting together crowdfunding is another thing to do, and investing in crowdfunded opportunities. So pros, depending on your role, you don't have to be an expert at everything. You can have the money. You don't have to be the one finding the deals. Might allow you to do different, larger, even better deals than you might be able to do yourself. So if you're working a full-time job as an engineer and you've got money or you've got the ability to do loans, you don't have to be the one out there hustling and doing motivated seller marketing. You partner. Learn as you earn. Some downsides, you can diminish your return over doing it yourself. If you buy just a regular buy and hold property, you get all of it. You bring in a partner, they're all taking their piece. Partnerships can go awry. I shouldn't underestimate that. That's like a big point, okay? There's a reason like half of the people in the country end up in divorce. And they love each other. You guys may not even love each other up front, okay? So expect it to be higher than 50%. Often less control, and that's kind of downsides of that. Short-term rentals, flying. Increase income on your investments by offering short-term rentals. Rent it out by the night, rent it out by the week, whatever you're going to do. Some examples might be boarding houses, rent by the bedroom, vacation rentals. Maybe with you living in the same property or property specifically designed for this purpose. So you may decide to do like a bed and breakfast and rent out one of your bedrooms or 2 of your bedrooms or something like that. Or you may buy a property that would be really good to rent out by the rooms, like a college place that has 9 bedrooms by UNC, as an example. Pros, can be significantly improved cash flow. You can crush cash flow when you do this, okay? Big cash flow boost. The downsides, it's increasing local regulation and restrictions. We're seeing a change of tide in the regulations and laws against short-term rentals. So if you thought, this sounds like a great idea, you totally need to research it because the laws are changing and they're not pro short-term rentals. They're definitely anti short-term rentals. Yeah, Munir.
Many HOAs are also now restricting your ability.
Yeah, many HOAs are definitely restricting your ability to do stuff. Absolutely. HOAs are not Satan, but HOAs protect our investments in a lot of ways. Cons, can be more active in investment with a lot more work. This is a lot more work, okay? If you think you're going to be able to do this passively, they're going to take like half to manage it for you. So in order to really get the returns, you're going to need to do it all yourself. Becoming harder to find properties where you can do this legally. Tax liens and tax sales. I might make this with like 5 minutes over. When property owners do not pay their property taxes, the county allows third parties to come in and pay the property taxes. So let's imagine Royce, same situation, you have the motivated seller, has a house. He gets really, really tight on money because he lost his job, but he's still living there. He's paying the mortgage, but he doesn't pay his taxes for some reason. He sends the money in, but he doesn't pay the escrow fee, or he got permission to pay the escrow fee afterward. So after a while, the county says, hey, we need this money in order to run the county, to kind of do the parks, to maintain the roads, to do all this stuff. We can't wait for Royce to get a new job. So we will allow some other person, a third-party investor, to come in, pay Royce's taxes. And as a benefit, as a kind of like reward for paying Royce's taxes, we will be able to collect, as the investor, the interest rate that the county has levied for someone coming in and doing that. So it might be 8%, 10%, 15%. Sometimes they bid them down. It varies by county. Sometimes it's fixed rate, and you're kind of bidding down the amount you pay, or so there's all sorts of variations. So basically, Royce can come in, not pay his taxes, and Kevin can decide to pay Royce's taxes. Then when Royce finally gets his job, and he's like, hey, listen, I want to get caught up on my property taxes, he goes into the county, and they charge him a fee, 8% per year, whatever it is, and Kevin gets that fee for doing it. So you can invest in that way. Now, one of the big perks of doing tax lien investments is, what happens if Royce goes like 3 years and doesn't pay his property taxes? It's more money to you, but more importantly, what's the big plus? You can actually foreclose. You can do a tax lien foreclosure on Royce and say you did not pay your property taxes for 3 years. I'm going to come in and actually take control of your property. It wipes out the mortgage because tax liens supersede the lien for the mortgage. And so basically you get a property for what you paid in property taxes for the 3 years. Okay? That's like the grand slam home run situation of doing those. Happens really, really infrequently. But it is a big upside when you do it happen. Now really what happens in practicality is Royce has a mortgage on the property. His lender in almost all cases is going to come in and say, I'm not going to have my lien on the property wiped out. We will pay the property taxes, and we will foreclose on Royce. Okay? So that's usually how it happens. So it's highly unusual, but that's what you can do. When property owner does not come back, catch up, they pay an interest rate penalty to pay your tax. The property owner goes X years, they might be able to get it. Okay, so pros and cons can be largely passive investment. You go to the tax lien sale, you buy $1 million worth of tax liens if you can get them there, and it's largely passive. Might acquire property for back taxes. We talked about the big plus side of doing that. The cons, I guess I didn't do one at a time. Increased awareness has driven down returns. So this used to be like a super secret thing where hardly anyone knew about it, and only really sophisticated investors did it. It's all over the place now. So you go to the tax liens, there's tons and tons of people there, amateurs and professionals alike. There's a really low probability of getting the property. This is not a strategy if you're trying to acquire properties. There are some really advanced strategies you can use in order to try to maximize your chance of getting the property, but beyond the scope of this class. Can be time intensive to research liens to find ones to bid on and invest in. When I've done some of this, some of the properties I was paying taxes on, total crap. And I probably shouldn't have paid taxes on them. I got lucky and got my money back and some returns, but sometimes it's like you're bidding on a small triangle of land, like a grassy knoll between 3 buildings, 3 commercial buildings, and no one cares about the property. They're like, fine, foreclose. Go ahead and do something with that 16 square foot piece of grass. Doesn't matter. And so they'll do stuff like that. Sometimes it's hard to know what you're paying taxes on. Sometimes you don't want the property. So there are times when they haven't paid taxes on it because it's a meth lab and it's going to cost like $1 million to remediate or something like that. So sometimes you don't even want the property. All right, wholesaling. We've been talking about wholesaling a lot tonight. Bird dogging is like the cheesiest, most admin way of just researching properties. Oh, this one looks like it's promising. Investor, go do research on this. Pay me a couple $100. That's what bird dogging is. Virtual wholesalings, that's wholesaling in other markets. So when I was running our wholesale company, we were in 280 markets. I wasn't in personally 280 markets. I was doing 279 of them virtually. Okay, so we were doing analysis of deals and marketing those in other markets and doing it virtually. Wholesaling, where you're going out there finding motivated sellers, talking to them, negotiating deals, and then selling your rights to those contracts. That's what wholesaling is. And then we talked about wholetailing, which is wholesale retail, finding a retail buyer to do that. Pros, short-term income. Little to no risk of market conditions because you're in and out and you don't actually own the property in almost all cases. Since you're not usually owning property for more than one day, if you're closing on it in the morning and you're selling in the afternoon, you don't have ownership for a long period of time, so you're not really at risk of market conditions. And then really the cons are, this is a job. Don't be fooled. This is not a part-time thing. This is like hardcore job stuff. And it might be more profitable and cleaner to get a real estate license. Because if you're a wholesaler, you have to go find the deal, someone who wants to sell, and find the buyer, someone who wants to buy it, and you probably need to get a deal that's a pretty big discount, right? And so you're doing this, and is the fee usually more or less than what a real estate agent would make selling a property? Less. So if you were going to do this, you could do half the work, find either the seller or the buyer, and get paid more. And it's easier to convince somebody, listen, I'm not going to buy your property. I'm going to put an option on it, and I'm going to sell it to another investor. It's easier to tell somebody, I'm going to list it for you, I'm going to get you maximum exposure, I'm going to get you maximum price, than it is to try to explain to them, you're selling at a discount, it's not good for me, maybe I have an investor that's going to do it, they're going to pay me my fee. Right? Half the work, more money. And it's probably less gray, legally. Few opportunities in our market for investor-grade wholesale deals. The market's hot. It's hard to find them. More likely to find these outside the MLS, spending money and time on marketing. And it requires sales skills. You really, in order to be a successful wholesaler, you need to know how to do all the deals. Because if you only know how to do one, you're only getting a small fraction of the people that call in. You know how to do all the deals, and you've got all the different tools in your toolbox, you're going to end up doing a lot more deals. Okay? All right. So what are the 2 best investing strategies in our market right now? Which ones do you like? Lease option. What else? Nomad. What else? Is buy and hold bad? No, I think buy and hold's pretty good in our marketplace. What about development? What's that? Yeah, we talked about it. So what are your, I don't like it. I mean, I evaluated it. I said it's not, I mean, I've done a lot of the other ones, but not that one. So what are your 2 favorite? Nomad and lease option? No Nomad? Those are your 2 favorite? Any other ones? So here are mine. Those are 2 that I think in this marketplace, with our current market conditions, I think those are the 2 best strategies. If you're willing to move, Nomad. In my opinion, it's by far the best strategy. Buying every year, dollar cost averaging, doing that. If you're not willing to move, I think this is actually a pretty close second. Lease options. Your spouse doesn't want to move. And then because I thought for a second I was going to have extra time, which I don't, this is actually a sheet from the old Carlton Sheets course showing you like what the situation is with the property. For example, the property offered below market or low interest assumable mortgage. This is what the situation is with the buyer. This is the situation is with the seller. And then here are all the different creative financing, no money down, kind of transaction options. And it shows you which ones work with which. So if you have never bought the Carlton Sheets course, or if you haven't, go look for this one. It's called the Creative Options Grid. Or if you haven't ever bought it before, go find it on eBay, because this thing is actually a really cool cheat sheet. If you're doing any type of creative deals, this is actually a really clever form. And most people don't even know it exists. But it's worth the $100 or so that you'd have to pay to find Carlton Sheets on eBay or whatever it is. It's good stuff. So I thought I'd have time to teach that. I don't. Any questions on the 11 best strategies for our marketplace or anything like that? Sorry I went over a couple minutes. I did try to go fast. I thought I was going to be like really relaxed and kind of answer questions. And goes to show, I think I need to teach like 3-hour classes. Thank you very much. Stick around for the class after the class. We'll see you soon.